New York City, I'm Shauna Smith alongside Brad Smith. This is Yahoo Finance's flagship show, The Morning Brief. Well, stock futures are slipping near 30 minutes ahead of the opening bell on the street, at least for the Dow and the S&P 500. We have the Dow on a 6-day win streak, the S&P 500 breaking a 4-day win streak. The Nasdaq Composite, though, pointing to gains here at the open.
And Treasury yields, they are ticking higher here. The benchmark 10-year around 4.5% here. Actually, it's just barely lower as of right now. So we'll continue to track that. The moves in equities and yields come as Fed officials signal rates may have to stay higher for longer to curb inflation further here. So let's get right to it with the three things that you need to know, your roadmap for the trading day. Yahoo Finance's Jared Blickery, Dan Halley, and Madison Mills have more.
That's right. Dow futures under pressure this morning after a 6-day winning streak. Wall Street is questioning the timing of rate cuts. Many Fed officials push for that higher for longer narrative to get inflation down to its 2% target. And on the other side of the pond, the Bank of England holding rates steady at a 16-year high, but the central bank signaled cuts are on the horizon. 2 of the 9 members voted to cut rates at today's meeting.
We're tracking some further weakness around AI stocks. Shares of ARM Holdings falling despite a Q4 earnings beat. The move lower coming on a disappointing full-year forecast for their fiscal 2025. Revenue was projected at $3.8 billion to $4.1 billion, but analysts were looking for around $4 billion, so the lower end of that was disappointing. Full-year profits are forecasted to be $1.45 to $1.65 a share. That lower end missing expectations of $1.53 a share.
And some signs of weakness in the streaming space. Warner Brothers Discovery reporting weaker than expected results for the first quarter. A heads up to all streaming consumers, Disney Entertainment and Warner Brothers Discovery announcing a new streaming bundle that's going to include Disney Plus, Hulu, and Max. That new bundle launching this summer, and it's going to be available to purchase on any of the 3 streaming platforms' websites. There will also be an ad-supported and ad-free plan. That announcement coming as Warner Brothers reports first quarter results that missed expectations on both the top and bottom line.
Well, good morning, everyone. We've got to take a look at some of the big movers of the morning, mostly driven by earnings here. And we're going to go kind of around the horn here with it. One of the huge ones that I'm tracking this morning, Airbnb, a company, of course, that did report yesterday after the close. However, we're still seeing shares move quite drastically here pre-market. Taking a look at shares, they're down right now by about 8% here with about inside of 30 minutes until the start of trade. One of the huge things that jumps out to me that was talked about on this call particularly is where this company is going to actually continue spending. I believe that analysts and investors might have given a little bit of weight to this as well in 2 areas particularly where they're going to continue investing in the business and could compress margins here that they talked about on the call. Ellie Mertz, the CFO, over at Airbnb, talking about marketing, one of those areas that you could potentially see some margin compression in order to drive growth. But then there's also the opportunity, they said, to add more personnel. That indeed a good thing for some of the product development pipeline, but at the same time, that's a new cost that a lot of investors out there may be trying to factor in.
Yeah, I think, Brad, when you take a look at so many of these earnings reports that were out this morning, we have Airbnb, what you were just talking about. We also heard from Hyatt. That was a big disappointment in terms of their guidance. And then we're also hearing from Roblox this morning, and that's showing some weakness within their business. And I bring all these 3 stocks up because it's really showing us a better picture of the consumer right now, right? And the pressure that the consumers are under, given the fact that inflation has been so persistent. So when you take a look at Roblox numbers, you got that stock off nearly 27% here in the pre-market. Their second quarter forecast missed expectations. They talked about weak engagement, booking guidance, so that's slowing growth rate and the ability here for that company to monetize the platform. Still a key question here for investors. And then when you flip back over to the travel segment, what we're hearing from Hyatt and what we're hearing from Airbnb, we certainly are seeing a bit of a pullback here in consumers' willingness to spend. Yeah. And then you also got to ask how much weaker this could potentially, or worse this could potentially get for these names if we do see a huge disappointment in this very important summer travel season. And if consumers then aren't willing to spend like they have in the past couple of years, that, of course, could be a big headwind for so many names within this sector.
Yeah, absolutely. I mean, when you mention Hyatt and what we've seen kind of as a broader common denominator within some of the travel earnings over the course of the season is just how people are financing travel trips right now. Of course, it's way different for the corporate travel spends that are starting to reemerge and really be a profit balloon for some of the companies right now. As we were speaking with Delta early on in their earnings season, some of these companies don't get to a profit without that corporate part of the business. And so now, if you're focusing in on Airbnb or in on Hyatt and looking at the leisure or leisure travel, or even they're not going to see that same type of profit level and the type of spending that they're doing. As we were looking back to Affirm's earnings just the other day, and how many people are actually breaking things up into payments, or in Airbnb's case, they would talk about how people might tap into a partnership that they have with Klarna, where you're essentially paying a portion of the trip and then saying, okay, I'll pay off the rest over time. I just need to make sure that I've got the thing booked, that I can get out there, experience the economy and this experiential economy, yada, yada, yada. But at the end of the day, I think the way that people are spending is shifting dramatically as well, to your point here too. And that's showing up for Roblox as well and the consumer there. And that's why you saw bookings down. Well, not down. The bookings just didn't keep pace with the growth that they had seen in some of the other parts of the business, both hours and then additionally just looking at the bookings only growing, 2% in this most recent quarter.
Yeah, certainly. So real headwinds here across the sector for those names. Some of these names that are reporting this morning when you take a look at Airbnb, Hyatt, and also Roblox. All right, let's get to the latest econ data that is out this morning. We're seeing a bit of a movement here in yields. You've got yields falling back, and that drop actually came right on the heels of the jobless claims print that we got out this morning. So when you take a look at that jobless claims number, jumping to 231,000, it was the highest level that we have seen since August. And this also comes on the heels of some softer than expected prints when you take a look at the manufacturing and services ISM prints that we have gotten out recently. So what does all this mean here for the Fed? We want to bring in Mark Zandi. He's Moody's Analytics chief economist, joining us now. Mark, it's great to see you here. So you've been talking about the fact that the Fed should be really thinking about cutting soon. We are clearly starting to see weakness within the economy. I'm curious, though, from your perspective, if the Fed does not cut this summer, what does that then do for the odds of a recession?
Well, it'll increase them. I think the economy is fine. It's resilient. It's doing well, but interest rates are high, and it's those rates are like a corrosive on the economy. They wear the economy down, and at some point something could break. So the risk that they're taking here is that they undermine the economy and recession occurs. But we're a long way from that, Shauna. I think the economy is generally resilient. But I would, at this point, if I were king for the day, I'd be really cutting rates at this point, because I do think the economy could use that relief.
Mark, what happens though if we don't see the Fed cut? When we talk about the risk here of something breaking in the economy, what does that then potentially look like?
Well, it could be a number of different places. The financial system is under a lot of pressure. The yield curve, we've kind of forgotten about that, but it's still inverted, meaning short rates are higher than long, meaning the funding costs that banks and other financial institutions face is high relative to their lending rates. That's not really a good place to be for a bank, particularly when loan growth is soft because of the tightening in underwriting standards, and regulatory costs are up because of the increased scrutiny, credit conditions are eroding. So the financial system is under a lot of pressure in that kind of environment. That would be a good case for something breaking. We got a taste of that a little over a year ago with Silicon Valley Bank and the bank runs. So we've experienced something like that. But that's the kind of thing I'm worried about in the context of persistently high interest rates.
So all these things considered, Mark, what are you going to be listening for in the tone of the Fed? We've had a bunch of Fed speak already this week, and we're gonna end this week with even more Fed speak tomorrow, and one more speaker later today. What have you made an aggregate of what they have to say about their read on the economy thus far?
Well, they're taking a different position than I am. They clearly realize that these rates are high and that they're putting pressure on the economy, but they are more focused on making sure that inflation is back to their 2% target. By the measure that they're focused on, the core excluding food and energy consumer expenditure deflator, we're not there yet. So they want to get there. So I don't think at this point it's really about the data, less about what the Fed officials are saying. They've made it pretty clear that they're not going to cut rates until inflation by that measure is at 2. And so that's going to take at least a couple, 3 months of data that would square with that forecast before they start cutting rates. So I expect they're going to just stick to that message and keep pounding it until the inflation data, as they are focused on, comes in.
Mark, should it be that 2% target?
No, it should
What should
not.
it be?
If you were asking me de novo today, without the legacy of that 2%, I'd say it should be closer to 3, just given that the underlying growth rate of the economy is slower than when the 2% target was put into place. But I think the Fed officials want to get back to 2, establish credibility, make sure that they've done what they said they were going to do. And then once they get that 2%, then I think they'll take an opportunity to change the framework for conducting monetary policy. And I don't think they're going to pick a number per se, but they're going to, and I'm not sure exactly how they'll do this, but they'll figure out a way to give them a little bit more flexibility. And next time around, they won't have to get down to that 2. Just a quick point of interest: if you have a 2% target on inflation, given the underlying growth rates in the economy and given the typical amount of interest rate cutting the Fed does during recessions, in a typical recession, we're always going to hit the zero lower bound, meaning the Fed's always going to bring interest rates down to 0 and then have to quantitative ease. And that's something they really don't want to do. So that's why 2 is not the right number. Probably something closer to 3 would make more sense.
Is the Fed once again facing a credibility risk? I mean, transitory for too long, and then now we're staying in the higher for longer conversation for perhaps longer than we would have anticipated at this juncture when we were coming into the year looking for several rate cuts, and now that's cut down to 1, maybe 2?
Well, I think their thought process is they're ensuring their credibility. Like they said, hey, look, we're going to hit 2%. We're not cutting rates until we're at 2%, and we're confident that we're going to be there. And so that's what they're desperately trying to establish here, that they do what they say they're going to do. Even though they're taking an increasing risk that policy will break something in the financial system or the broader economy, in the labor markets or somewhere else, and we land ourselves into recessions. But they're desperately trying to reestablish that credibility.
All right, Mark Zandi, Moody's Analytics Chief Economist. Thanks so much for taking the time. Always a pleasure to speak with you, Mark.
Anytime. Take care.
You too. Well, ARM shares are under pressure today after its full-year revenue forecast missed the street's expectations, but the chip design company beating analysts' EPS and revenue expectations in its fiscal fourth quarter report. To break down what's next for ARM, we've got Yahoo Finance reporter Dan Halley here. Dan, what do we know?
Yeah, obviously the miss on the full-year revenue, not something that Wall Street really appreciated. I think that when it comes to a company like ARM, they're still are relatively new as far as public companies go. And I think a lot of people are banking on this as being a huge AI play. The reality, though, is this is a company that makes the majority of its revenue through mobile devices, so mobile chip licensing, not necessarily data centers. Now, that doesn't mean they're not in data centers. They are. Some companies use them. Some hyperscalers actually use them when they design their own personal chips for their own clouds. They're also in automobiles. They're in IoT devices. So they are everywhere. But the vast majority of their revenue still does come from those smartphone sales. And smartphone sales have been pretty morose, I would say, over the past few quarters since the tail end of maybe 2020, 2022, or in that time frame, they started to really fall down, and they're bottoming out. We're starting to see some growth again, but look, that's going to continue to be a headwind for them as far as revenue goes. And I think Wall Street going into this, a lot of people were just amped up on AI. We've seen this before with other companies where they don't absolutely blow away anyone in terms of their revenue, their guidance. They're not pulling in NVIDIA, and so they're punished as a result. But not every company's NVIDIA.
So is this indicative, do you think, of a sector-wide slowdown, or is this more specific here to ARM's business?
I think it's more specific to ARM's business than anything else. I think, if it was sector-wide, we probably would have heard something from NVIDIA by now, right? I mean, expectations to them are through the roof. You'd expect if there was some serious miss coming, in the AI sector, then we would hear perhaps something from them. But look, these companies are still obviously growing very well. AMD did pretty decently for its quarter. They had issues on the gaming front, and that was their problem. Intel, they're still really trying to ramp up a lot of the AI efforts. And then look, we're talking about the AI PC race that we're seeing. Well, ARM chips go into Apple. They just announced their new chip, the M4. They go into their Qualcomm's as well. Qualcomm uses ARM-based chips. They're going to be launching AI PCs. So we could start to see a little more as far as consumers go outside of just the smartphones. But I do think that the key issue here is that people are just really jazzed up about AI, and they expect everybody to be like NVIDIA, and they're not. That's just the fact.
All right, all of us are going to be watching closely for that NVIDIA earnings report when that drops in a couple weeks here. Dan, thanks so much. Hype already.
Hype. Ooh.
Indeed. Dan, appreciate it. Everyone, we've got all your markets action ahead and much more here on Yahoo Finances. We're just getting started on the morning brief. Bumble shares are abuzz after a surge in paying users. We're going to speak with an analyst from Citi next. And Warner Brothers Discovery shares, they're slipping after missing on expectations in the first quarter despite growth in streaming. We've got the full breakdown of those results on the other side of the break. Plus, Airbnb sinking after giving weaker than expected guidance. We'll speak with an analyst from Needham later in the hour. All this and more. You're watching Yahoo Finance. Investors swiping right on Bumble earnings. Shares of the online dating app surging this morning after beating Wall Street revenue expectations, driven by growth in its paying users. For more on the latest results here, we're joined by Ygal Arounian, who is the Citi U.S. Internet analyst here. Great to have you here with us to break down why Bumble shares are abuzz this morning. What do you think investors are zeroing in on?
Hey, thanks for having me this morning. Look, the biggest thing here is that the expectations have been so low, both for Bumble and the broader dating app ecosystem in general. Match also reported earlier in the week they lowered their full year outlook, and we've seen declining data on the payer side and the monthly average user side on time spent. Really for a couple of years now, the broader online dating ecosystem, Bumble's seen a pretty pronounced slowdown in growth just really over the past couple of quarters, and it happened pretty quickly. So the expectations have certainly gotten low, and with the 1Q beat and the fact that they didn't lower their full year outlook, I think that was enough to get investors a little bit more excited here. But there's still a lot that's hanging on a new product that just launched recently, or an app refresh, and the expectations that that's going to lead to accelerating growth into the second half. And we're going to need to see that play out for this momentum to continue.
Do you think it will?
Well, we hope so. It's a little early to tell. The new app, the app relaunch just came out last week, so it's just a week. I mean, management talked about it pretty positively on the earnings call. They're seeing some good early signals. They're seeing some strong adoption of some of the key features on it. They say they've gotten good feedback and testing. So, that's certainly what management is hoping and expecting. Again, just pointing back to Match and what they're expecting with Tinder, it's a very similar story. They're expecting growth to accelerate and see an inflection point in the second half. They've also refreshed the Tinder app. There's more product changes to come over time. And so both Tinder and Bumble are expecting these products to kind of turn around the stories and some of the softness we've seen in user trends, and lead to reacceleration in the second half.
I mean, and they've talked about how much they're leaning into the Gen Z customer on Bumble as well on the earnings call. I just wonder, when we hear reports about Gen Z tapping into credit or loans earlier than their millennial counterparts, how much of the customer lifetime value investors should really rely on to be infused into the Bumble financial performance over time?
Well, Gen Z is super critical in this world, right? And I mean, that's the kind of obvious statement. They're coming in as early users and expected to stick around. They'll move in and out as they get into relationships and out of relationships. But this is a young cohort that over time will presumably spend a lot of time and money on the dating apps. And some of the challenges that you've seen in terms of users and the slowing growth, it is really, we're seeing from Gen Z and younger audiences that haven't been using dating apps the same way over the past couple of years as younger generations in the past have. And the management teams at Match Group and Bumble are really trying to evolve the products to make it more in line with what younger audiences are looking for, and to try to bring them back into the ecosystem more. So if they can get it right and make the experience better, they'll get younger audiences to spend more over time. There's definitely some softness right now. Match called out to it earlier this week, and they're seeing some softness in how people are spending. And that's not a new phenomenon. They said that it did get a little bit worse, but this is a bigger picture thing than just how Gen Z and younger audiences are spending today. This is about getting interest back up to higher levels in the way that it's been 3 to 4 years ago.
So, y'all, given that changing landscape that you're just describing here, the fact that companies are having to adjust to this new reality here within the industry, who then is best positioned, do you think, to take advantage or best positioned to capitalize maybe on some of these changes that are happening?
Well, I mean, the online dating ecosystem is, at least in these specific apps, are really dominated by 2 big players, and that's Match and Bumble. There's plenty of smaller apps, but these are the 2 dominant players. So you would think that they're the best positioned here. But they do have to capture some of these changes. So some of what's happening may be a little bit hard to reverse in the near term. I think you're seeing younger people, they're back at school and more in person. You're seeing that play out a little bit. I think younger audiences are spending a little bit more time on social media and meeting people on social media. We certainly hear that, at least anecdotally, on how people are just messaging people on Instagram, for example. So really those that'll capitalize the most are the ones that can kind of follow these trends, make the experience strong, and bring people back into their ecosystem, spend more time there. I think maybe balancing this real world and digital world in a strong way is maybe one of the most challenging parts to figure out. But the larger players are probably the ones that can handle it the most.
But Nicole, who though is best positioned, Bumble versus Match right now, given that?
That's a really tough question, and it depends. I think I'll say it this way. And Bumble's challenges maybe a little narrower than Tinder, but Bumble's much smaller than Tinder, right? Tinder dominates the dating app ecosystem. It has about 40% of the time spent on dating apps is spent on Tinder. And Tinder's seen their subscribers decline for nearly 2 years now. So I think what Tinder needs to do to really get back to a much healthier place is maybe there's more work there. Bumble kind of they saw some challenges in the numbers over a couple of months and quarters, and they quickly went to work and revamped their product. Bumble's still seeing users grow on a global basis. They're still much smaller than Tinder is, so the hurdle for them might be a little bit smaller. But that's not to say that Tinder, as the market leader, doesn't have the ability to get back on track as well.
Just want to see some of that first move data, honestly, Yigal, just to see how many people are getting the opportunity or getting it put on them to make the first move. One of the hallmarks of Bumble, of course.
Certainly. Yigal, we got to leave it there. Thanks so much for joining us here at Yahoo Finance. Thanks for your time. All right, let's talk about another stock that is trending here this morning. Warner Brothers Discovery shares, they are falling after reporting earnings and revenue that missed expectations in the first quarter. They did, though, see growth in their streaming business. This comes after announcing a new bundle with Disney, which will offer their streaming services Disney Plus, Hulu, and Max at a price that's yet to be disclosed. Yahoo Finance's Alexandra Canal has the details on that for us. Allie.
Hi, Shauna. Yeah, the bundle was talked about quite a bit on the earnings call, which just wrapped up. Management saying there are clear business benefits to this. That includes driving incremental subscriber growth. And since consumers will have to retain all three of those services, Disney Plus, Hulu, and Max, WBD said it expects the product will increase retention and lower churn and help support lifetime value of the consumer, in addition to increasing marketing efficiencies. And this comes as we've seen bundles gain more and more traction over the past year or so, as media giants really attempt to not only lure subscribers to their service, but retain those subs. The bundle will go live this summer. As you mentioned, we do not know a price yet, but management did say on the call that it will be based on the current price of Max. Now, Max is one of the more expensive streaming services on the market, with the ad-supported tier costing $9.99 and the lowest priced ad-free version coming in at $15.99. But this announcement does come as we saw streaming momentum in the quarter. The Max streaming service adding 2 million subscribers ahead of estimates. The direct-to-consumer division also profitable, with management saying that it expects to remain profitable throughout 2024. But of course, not all positive moments in this report. We saw a miss on both the top and bottom lines. Linear networks continue to struggle. Network advertising tumbling 11% year over year in the quarter.
It's really interesting, Allie, and I keep thinking back to one of the stats that jumped out from that Deloitte Digital Media Trends survey that you and I have talked about, that we've discussed here at length, with 36% of Americans believing they're not getting the bang for their buck on SVOD, streaming video on demand here. So how is bundling, how is making sure that they're even going after specific titles or rights to broadcast certain sports even, how is that going to change the value proposition for a lot of these companies here?
Well, it gives consumers more choice. And at the end of the day, the idea that you have more choice as a consumer, that's going to be a net benefit moving forward. Also, when you think about content, sports in particular, the stickiness of content is important. You want to have people continuously coming back. Sports is one piece of content that you can't necessarily watch later. It's something that's on-demand viewing. You need to watch at that time, which is why the NBA rights are so important for a company like Warner Brothers Discovery. They did mention that on the call. He wouldn't elaborate where talks currently stand today, but CEO David Zaslav said that he's hopeful they will find a deal that is fair for both sides and that they have the ability to match third-party offers. The Wall Street Journal reporting that NBC Universal is giving Warner Brothers Discovery a run for their money, literally, when it comes to these NBA rights. So we'll see where that develops.
More sports documentaries. I mean, it's a big time, winning time all over again here in New York City right now with the Pacers versus the Knicks. Knicks. Of course, the Knicks are up right now in that series. Anyway, that neither here nor there.
Still sour about that.
Well, slightly. Somebody's got to be, and it's me.
All right, Allie, thanks so much for
Thank you,
breaking
guys.
that down. We're just about 30 seconds here until the opening bell on Wall Street. Let's take a look at where futures are here ahead of the open, because we are well off the lows of the morning. You've actually got the Dow pointing to gains here, I believe, at the open. Make sure that this is futures here. We also have the S&P and Nasdaq also moving here. Now, we saw a bit of a reversal after we got that jobless claims print out this morning here, Brad. We saw yields drop on that weaker than expected print when you take a look at the fact that claims rising the highest level that we have actually seen since August. So I bring that up because, of course, and that brings into the debate about whether or not we will see the Fed cut, and if a print like that makes it more likely that the Fed is going to cut sooner rather than later.
Yeah, a whole host of Fed speak that we're getting over the course of this week as the bell ceremoniously interrupts me and all of the different Fed speakers that we're expected to hear from. It's going to be interesting to see where that continues to move the dialogue. As today we're going to hear from San Francisco Fed President Mary Daly at 2 p.m. Anyway, we'll get back to the Fed speak in a hot second. Take a look at the NYSE and the Nasdaq. While we have the shots up here on the day, you've got the Children's Tumor Foundation ringing the opening bell at the NYSE, and oh my goodness, Ferrovial is ringing the opening bell at the Nasdaq. Good friends from Ferrovial. All right, let's take a quick check of the market, sponsored by Tasty Trade here. We are mixed out of the gate right now. The Dow Jones Industrial Average down by about 0.1%. The S&P 500, you're seeing that flat just barely to the upside. And then the Nasdaq Composite tech-heavy average holding on to gains by about 0.2% to start off the day. Everyone, we will be right back on the other side of this short break with much more Yahoo Finance.
We got stocks here on the move, a mixed print here, or a mixed picture here this morning. You've got the Dow just below the flat line. S&P and Nasdaq, though, holding on to gains 3 minutes into the trading day. Jared Blicker has a closer look at some of these movers. Jared.
Thank you, Shauna. And indeed a mixed day, but not a lot of movement. Looks like the Russell 2000 outperforming by just a little bit, up about 0.1%. And just kind of thinking about where we are in the year, this is May, and this is the fourth best start to May that we've had in the history of the S&P 500. Here is the Nasdaq. And by the way, we are on day 7. So you can see the Dow's up just a little over 3% in this time period. Same for the S&P 500. And then we'll go to the Nasdaq. That's up 4%. One of the things I'm monitoring, though, is the fact that the volume is exceptionally low right now. And maybe that's because we are kind of in the summer period. Nevertheless, take it with a grain of salt. Here's real estate. That is in the first position today. That's up 1.5%. Tech, financials, communication services, all in the red. But let me show you what's going on in the month of May so far in these 7 days. Utilities is the outperformer, followed by communication services and tech, and then real estate. So you have two interest rate sensitive sectors that are leading stocks this month and also over the trailing month. You see utilities and staples. So there is a slightly defensive characteristic that the market has taken on. Just note that as the S&P 500 is now about 1% from its record closing high.
All right, Jared, thanks so much for that. Well, ARM Holdings shares under pressure today after its full year guidance missing the street's expectations and fueling concerns about the AI slowdown and companies taking a hit. For what investors need to know, Kimberly Forrest, Boca Capital Partners founder and chief investment officer. Kimberly, it's great to see you again. So let's start with what we were just hearing from Jared and kind of comparing that to what is playing out. It seems to be within the AI space right now, because ARM was the latest company to not really live up to those sky-high expectations when it comes to some of those tech leaders, when it comes to the AI space. And yet we've seen this rotation into a more defensive type setup when you take a look at the outperformance of utilities and consumer staples. What does that then signal to you at this point in terms of that market rotation?
Sure. Well, it's a couple of things. Probably the biggest thing that is in every investor's mind is AI for real, right? Because we've now had Intel, AMD, and ARM all kind of disappoint, especially with respect to the amount of their revenue coming from AI. And if you are a longtime technology watcher, this should not be a surprise to you, because technology doesn't spend whenever it's being developed solely just moving upwards and to the right at a 45-degree angle, right, on revenue. That doesn't happen. It's more lumpy. Companies will build out a data center and then pause, and then build some more and pause. And we might be hitting this. We'll know whenever NVIDIA reports next week. But I don't think you should throw in the towel. Now, as for the defensives, it does feel like people are anticipating a recession, and they often do pile into consumer staples and utilities thinking, well, the consumer has to buy those.
You know, one of the common threads that we've heard for companies that are most benefiting from generative AI right now is that they're all going to continue to invest aggressively. And for Meta Platforms, I think what they said on theirs was, look, this first quarter just shows one instance of how we're going to continue that incremental investment going forward. Are we witnessing right now perhaps I don't want to say the first cracks in the generative AI trade, because it still is an investment that these companies are putting forward, but when should investors expect some of those investments, the CapEx, to actually pay off?
Sure. Well, I mean, you bring up an excellent point. Right now, people have been solely able to invest by investing in NVIDIA. I mean, let's just call it for what it is, right? And some of the other semis got a boost from it. But as I said, building out the data center is part of it. Then you're going to have companies like Meta, Microsoft, and Amazon, and everybody else is going to pile in and start using the generative AI to maybe increase productivity. So I think that's an excellent question that you ask. And I would look for, who do you think is most likely to benefit from using generative AI? And we've just mentioned them, right? Amazon, Meta, and Microsoft. And to me, Microsoft is really probably the best position, because they'll get people to actually pay for it, not just advertising dollars. So companies who want to write better emails or sift through, their stores of knowledge and figure out what they have in their databases can use generative AI to mine that and maybe become a better, more productive company.
Kimberly, how much does Fed cutting play into this? Or is this a sector just given the hype, given the excitement, and given those real use cases, at least for some of these names, that it almost doesn't matter really what the Fed does in the short term?
Well, I think if you're a short-term investor, you don't really care what the Fed is doing. I mean, you'd like a rate cut for sure, because that would help out your multiple and your discounted cash flow, and all the math behind it rests on that 10-year bond and what it trades at, the U.S. Treasury 10-year. That being said, I prefer to be a much longer-term investor than the next 10 minutes or even the next year, because it does take time for AI and a whole lot of trends to kind of play out through the investing timeline.
Kimberly Forrest, who is the Boca Capital Partners founder and chief investment officer. Kim, thanks so much for taking the time today.
Thank you.
Certainly. Guys, coming up, travel trends. Airbnb says it's experiencing robust demand for summer travel, but shares slipping right now after earnings. We'll tell you why after the break. Robinhood shares rising after reporting record results in the first quarter. Its revenue from cryptocurrency jumping 232% to $126 million, and funded customers increased by 810,000 from a year ago here. One of the huge things that also jumps out from this report, net income increased year over year as well here, and we saw that ultimately move higher compared to a loss of $511 million last year. in the same comparable quarter here.
Yeah, when you take a look at these numbers here in terms of what is driving these better than expected results and the momentum that we're seeing within Robinhood's business, look at the gold business, gold subscribers, that gaining, that of course is providing some momentum here into the second quarter that we are currently in. Also some strength in their crypto trading business. That was something that was called out from a number of analysts here on the street in the immediate reaction to this print. And we have Mizuho's Dan Dolev saying that the results were, quote, very strong. And he was talking about some of the strength in the fundamentals of the business. When you take a look at funded accounts, monthly active users, and that crypto business, and his expectation that those gains are going to carry over into the current quarter, given the recent action that we have seen, and given the fact that volumes are expected to tick higher here, at least in the month or last month, what we saw in the month of April. So again, it looks like the street is satisfied with these results and exactly what that means here for growth going forward for a name like Robinhood.
Yeah, some new functionality as well that they're touting within this report. The 24-hour trading, or 24-hour market is what they're calling it here. 900 stocks and ETFs there that have really been put into play there, and the 24-hour market reaching new highs in overnight trading volume. So a lot of people staying up late, perhaps crushing some monsters, and ultimately just figuring out what their strategy is going to be overnight and for the next day.
All right. Let's switch gears here and talk about the travel sector. We've got shares of Airbnb actually falling after forecasting a weaker than expected revenue in the second quarter, the current quarter. The outlook here for nights and experiences booked in Q2 also showing some slowing growth. Now, this comes despite the company saying it's already experiencing robust demand for travel ahead of that peak summer season. Here with more, we want to bring in Bernie McTernan. He is Needham & Company's managing director. Bernie, it's great to have you here. So we just laid it all out, right? They did beat when it comes to Q1, but I think the real issue here and why we're seeing the stock under pressure is some of the commentary that we've got surrounding guidance. So really, what does this signal to you just in terms of not only Airbnb, but the travel industry at large and some of those headwinds that are facing the industry?
Yeah, well, I think it's key, especially when you're thinking about the stock reaction today, is the expectations coming to the print. They certainly raised following last quarter, and numbers probably flat to moving slightly up for the year for Airbnb. And again, some of that commentary that the company made on investments that are coming, especially in the second half of the year around sales and marketing relative to our expectations, likely keeping a lid on what some of the bulls were hoping for. And remember, this is a transition or investment year for Airbnb as well, too. As you mentioned, the broader context of the travel industry, Airbnb's growth has really slowed down to looking more like Expedia, looking more like Booking in the high single, low double-digit range. And this is because you had the business doubled basically from 2019 levels, so growth looking more like the rest of the industry peers, but valuation still at a premium, which is one of the reasons why we downgraded the stock heading into the print.
What do you think this next iteration of Airbnb looks like, especially as the company was really focused on providing a value pitch and positioning to consumers before? Where do you see that moving now?
Yeah, well, first off, I think it's important to remember the opportunity that they have. 90% of traffic comes to Airbnb organically, which sets them apart from their peers. And so they're trying to leverage that to move into other services, which makes a lot of sense. Brian Chesky, CEO, was talking about like an AI OTA app last quarter. He was talking about Icons this quarter, which is a high-end or at least a very unique experience.
They're going to be like the sneakers app with that, Bernie. I mean, people just going to be looking up the iconic experiences and stays and trying to make sure that it doesn't get all booked up before they can hop on there.
Well, that's the thing, is that we're talking about 4,000 nights per year that are going into this, and a company that does 500 million nights per year. So I think it's important not to, there's a long way to go to make experiences broader.
Fair point.
But as we're talking about expectations, when we talked to investors heading into the print, it was that they thought there was going to be upside to numbers for the year because of third-party data, and then B, this call option on expanding beyond the core. But as again, like given the premium valuation of the stock, we actually think it was a call option that you had to really believe that this was a company that would be able to take material share in moving beyond the core. So if it was that AI OT app, really taking share from Expedia and Booking, which again, that wasn't something that we were willing to put into our base case at least.
Bernie, when it comes to some of the slowing growth that we have seen and the softness here, at least it looks like initially in demand heading into the summer season, is the worst not behind it then for a name like Airbnb?
Yeah, I mean, that's what they're calling for. They're saying they expect revenue growth to accelerate in 3Q. That's driven by some events like the Summer Olympics in Paris. You got the Euros going on as well, too. So I think that's the hope for this year. But again, we're taking the broader view of that. This is a company that has had decelerating growth over the past few years, given the big pull forward from the pandemic. And we think that, absent a major turnaround and taking, major share in a new business line, you're looking at high single digit growth next year, probably trending to mid single digit growth over time. And again, for a stock that's a premium valuation and has done a great job in pulling forward margins as well. So margin expectations, 35% EBITDA margins for this year. Their GAAP net income positive. They generate, a bunch of free cash flow, 41% free cash flow margins. So again, a company that's done a lot, but now, the market's forward looking. And I think there's just been a lot of pull forward of the opportunity set for the company.
Bernie, you also cover Instacart, so let's talk about that stock move here real quick. The recent results that we're just getting. The stock actually still under pressure, off just about 2.5%. I'm taking a look at the note that you just issued following this print, and you said that there is an upside surprise here. You talked about some of the strength that the company is seeing, especially in order growth, that accelerating to 9%, up from 5% the previous quarter. What do you attribute then the weakness in shares to today?
Yeah, I want to say it's expectations. The stock has had a huge move since the end of the lockup that kept a lot of investors on the sideline, given the huge lockup that happened post-IPO, and it really has flipped from a consensus long. So huge beat in the quarter. We're taking up our numbers a lot. But even on our, on our raised number, stocks trading about 10 times 25 EBITDA, which is, a relative discount to an Uber or a DoorDash, but really has where the stock has been, settling out trading wise here post IPO. So we think it's an encouraging data point. We've been on the sidelines of the stock because of competition concerns. That's manifesting itself through Amazon's announcement a couple of weeks ago about getting more aggressive in delivery. But the company did have some positive commentary on cohort trends continue to move in the right direction. So we think it was certainly an encouraging data point for the company, and the shares weakness today is probably a function of the strength that's been happening over the past 2 months.
Yeah, and a question of when some of those partnerships will start to be really accretive to the business here, or at least visibly accretive here over time. Bernie McTiernan, who is the Needham & Company Managing Director. Bernie, always a pleasure to speak with you and get some insights. Appreciate it.
Thanks for having me on.
Thanks. Coming up, utilities has been the leading sector in the latest market rally. We'll explain why after this short break. It might be time to get defensive. Utility stocks are outperforming the S&P 500 in Wall Street's recent rally after a tough April. Our own Josh Schaefer is here to break it down. Utility man, Josh Schaefer. What do we know?
Brad, utilities been ripping.
They have been.
So the sector is
That
up.
sums it up. That's all you need to know.
That's basically all you need to
leading
know.
over the past month right now.
It's leading over the past month. We'll leave it at that. No, it's actually interesting taking a closer look at this yesterday. I talked to a couple of our strategist friends that are friends of the show and sort of breaking down what is actually going on in the utility sector. So when you look since April 16th, so really less than a month now, the sector's up 12%. That's about all of its year-to-date gains. It's now the third highest sector in the S&P 500 this year for year-to-date gains. And normally, utilities would be a little bit of a defensive play. Consumer staples have also rallied at a similar time point. There have been a couple indicators there, at least in economic data. We know we've been seeing some weaker data. You could point to something like jobless claims this morning, right? We're starting to see a little bit of weakness in economic data. You also had movements in the middle of April around rates, right? We had the Fed come out and say that another hike is not necessarily likely. And so that sort of took the 10-year down. When the 10-year yield has come down, utilities have gone up for just about the past year now. But really, when you zoom out, the real story was just massive underperformance for utilities over the last year. Utilities, Keith Lerner over at Cruise told me that utilities, the forward PE ratio compared to the S&P 500, so valuation here, was at its lowest level since 2009 entering March. So I think investors just largely seeing perhaps an attractive opportunity here and finding another sector that hasn't really joined the market rally to this point.
And then could you make that same argument, you would think then, for the outperformance that we have seen recently in consumer staples along similar lines?
Yeah, so I'm looking at our Wi-Fi Interactive right now. If you go to last year, consumer staples was up 0.2%. You had utilities up 2.5%. Even if you zoom out 2 years, you're really looking at a similar story here, right? You have consumer staples right there and utilities. So then we flip to the last month. What's now outperforming? It's your two sectors that just simply haven't done that well. So to some sense, it sort of just kind of adds up to a little bit of a okay catch-up trade. We've talked a lot about different catch-up trades over the last year. This is one that hadn't really participated yet. One other thing I want to look up while I have the interactive up here is we take a look at year-to-date, because one of the questions I asked strategists was, okay, so what does this mean for market leadership? Are we going to see more from utilities, or are we going to see more from comm services or energy? And I thought Kevin Gordon over at Charles Schwab had a good answer to this. He said when you take all three of these, you really get three different stories, right? Yeah. You get a cyclical trade, you get a growth trade, and then you get utilities, which is perhaps maybe a little bit more of a defensive play. What does that tell us? I don't really know. That was basically what Gordon told me in sort of a candid way of it's hard to really tell where the market's going from that perspective. And I think that really speaks to a lot of the starts and fits we've had with perhaps the broadening trade, right? We haven't had a clear broadening trade, largely probably due to the Fed and less visibility there. So until we get more visibility, which we've been saying for a long time now, maybe more starts and fits in different sectors sort of coming into favor and perhaps out of favor.
Makes a lot of sense.
Yeah, all things on the trailing rebound for utilities.
We had a lot to say about utilities.
We did.
A ton, yeah.
We don't have to stay all defensive, Brad. That was the takeaway.
We don't need to.
We can still play a little offense.
I mean, look, we could talk utilities for another hour. I know they have catalysts coming up at the top of 10 a.m., though, which is what you should stay tuned for on the other side of this show break. I'll be back at, 11 a.m.?
11 a.m., you better be here.
Well, yep, we'll see you on the other side.
It's 10 a.m. here in New York City. I'm Shauna Smith alongside Madison Mills, and welcome to our new show, Catalyst.
From equities to commodities, we're decoding trends and uncovering the drivers behind today's market moves.
Our team of experts, they are here to help you navigate all the possible outcomes to help you make the best decisions for your portfolios.
It is Thursday, May 9th, so let's dive into the Catalyst moving markets today. Uncertainty about corporate earnings are sending stocks lower in the season's final stretch. The Dow slipping for the first time in 7 days as earnings continue to put pressure on the broader market. While tech mainly delivering on those high expectations, the focus now turns to the big consumer names that are going to come out next week.
Plus, shares of Warner Brothers Discovery under pressure this morning after missing Wall Street's expectations. WBD, like many other media companies, is grappling with an unfavorable ad environment. Network advertising revenue that tumbled 11% in the first quarter from a year ago. The studio's business also struggling despite high-profile movies like Dune 2.
And corporate America is spending big on stock buybacks. Share repurchases in the first quarter are up sharply to the tune of $181 billion during this earnings cycle. A huge chunk of that is Apple, by the way. A potential signal that corporate America is bullish on the U.S. economy. Well, first quarter earnings season is in that final stretch, and so far results have been far better than Wall Street had feared. One example of that, companies stepping up repurchases of their own shares. For more on corporate America's spending spree, we are joined by Scott Kroner, head of U.S. equity strategy at Citi, joining us in studio. Scott, thank you so much for coming in. So I want to start on these buybacks because, as I mentioned, we've got Apple with a record-breaking $110 billion. But then you've got a company like Bumble down over 30% year to date. They have $260 million in cash, $600 million in debt, and they're announcing buybacks. So should investors be viewing all buybacks as created equal here?
Well, I think to a certain degree, yes. The bigger picture here that we want to be attentive to, in our view anyway, is that we're looking for an acceleration in earnings growth this year. With that, we're expecting a significant increase in free cash flow generation. So we're looking for free cash flow for the S&P 500 to grow to the tune of 10% this year. And what that does, it frees up a lot of financial flexibility. Share repurchase is something that's been going on an ongoing basis for several years. Our math is that on a net basis, the S&P aggregate share count's been reduced by about 1% a year over the past several years. We think that trend continues. Okay, so what this does, the free cash flow improvement augments financial flexibility that leads to decisions between CapEx, dividend growth, and repurchase. Many companies are viewing repurchase as a signal that they view their fundamentals as in a pretty attractive position looking forward.
So, Scott, just zooming out also and just taking a look at earnings season, what we've heard from corporate America, obviously, over the last several weeks. Obviously, it has been a strong earnings season so far. But I'm curious, though, in terms of some of the guidance and the forecast numbers, what is that then? What does the setup look like for the current quarter and then, of course, the second half of the year?
Color us bullish on the S&P earnings outlook, okay? So going into the quarterly reporting period, it's not uncommon to see expectations come down. So you get to a point where positive surprises are nearly a given, okay? So the positive surprise dynamic with Q1 earnings is not a surprise, okay? First point. Second point, though, is that when you look at what's happened with the aggregate consensus expectations for the full year, they haven't changed.
Right.
Okay, so we call it a beat and hold. But what this does, in turn, given what we know or think we know about the economic condition right now, is that we're going to be in a position for ongoing fundamental tailwinds to support U.S. equities as this year unfolds.
Then what does that leadership look like?
Well, okay, so here's the trick. So last year we know it was all about Mag 7. Okay, it was an important contributor to the aggregate index return. If you look at the performance off of the November lows, okay, it began to reflect broadening, which has been a call of ours going back to last summer, actually. And the view had been we wanted a barbell growth in cyclicals. Well, off the November lows, you've had industrials and financials right alongside tech as a leadership. This year, you've seen energy perform quite strongly. My point is that broadening has been happening under the surface. Where does it go from here? This is somewhat controversial, but we are still of the view that we're going to get a Fed pivot as we get in the middle part of this year, perhaps later in the third quarter. What that does is set up for the rotation to continue down a path of those parts of the market that should benefit from lower Fed funds. That's going to include consumer. Okay, so we've gone overweight consumer discretionary. We recently upgraded utilities from a long-standing underweight to a market weight. We've upgraded staples. We've remained positive on banks. We've upgraded autos. My point is that we've begun to shift our focus towards those companies that should benefit from a gradual reduction in short-term interest rates.
But your market weight on information technology?
You have to allow that the expectations had built pretty aggressively by the end of Q1 going into Q1 reporting period. So tactically, we pulled back on tech. We'd been overweight for the better part of the past year. So we've been giving that part of the market room to catch its breath for fundamentals to grow into the price action. But let's be clear on this. We still think that longer term, this mega cap growth cohort of the market is going to be mission critical to index levels, moving higher over time. What's happening is these companies are the leaders of free cash flow generation, as we've talked about, and where they're deploying it is a combination of things. It's repurchase, we're starting to see CapEx increase now. All of these are pretty constructive signals for longer term earnings growth. So we're in the game, we're just allowing for a bit of a rotation inside the market over the next several months.
Scott, how dependent is everything that you just said here in the last 90 seconds or so? How dependent is that on the Fed cutting? And what happened if the Fed does not cut then this summer?
Okay, let me get controversial here. So, we think with the Fed, we have to be aware of unintended consequences. Okay, so higher Fed funds, been negative for those parts of the market, more debt laden, real estate, utilities as an example. It's actually been a positive for mega cap growth. These companies carry big cash balances and they're earning significant interest income now, right? So what we would argue is that we have to be careful if the Fed's affecting different parts of equities differently, but at the same time, we're pretty big on this theme that the Fed focus is mainly on Main Street, and Main Street is not the same as what's fundamentally driving Wall Street, i.e. the S&P 500. So we think, all told, the Fed's in a position where it really should be positioning to pivot, or at least become less restrictive. That takes some rate pressure off and risk of further things breaking. But under the surface, what we're arguing here is that we've seen it. The market is doing fairly well, even despite the last couple hundred basis points of Fed rate hikes.
So if you look at some of these consumer names, like a Starbucks, for example, that is showing cracks with the consumer, do you think that's an idiosyncratic story?
I don't know. I think there's probably an idiosyncratic aspect. There's probably a price elasticity demand aspect. There's probably many moving parts to the discussion. When you step back and you look at the retail component in aggregate, here's what I like to point out, is that in aggregate, the retailers sold off very hard in the first half of 2022 as the Fed was just going down its hawkish trajectory and has been flatlining for 18 months. Okay, the market's priced in a lot of the concern regarding the Fed on consumer discretionary for some time now. So when you do see something emerge, on one silo of the consumer, we ask the question, is this a TAM issue? Is it a company specific? Is it a read through to broader consumer? And where I'd like to go with this is that it's the same notion of the Fed influence is happening differently in different parts of the economy. If you're a non-saver living paycheck to paycheck, higher inflation combined with higher interest rates has been an issue. If you've been a saver benefiting from interest on money market funds and deposits now, it's a little bit different story. So I think we're aware and we're watching. I don't know that we can say that fraying around the edges of the consumer in aggregate is a big negative for consumer discretionary fundamentals.
Scott Kroner, great to have you here in studio. Thanks so much for stopping by here with us. We appreciate it.
Great
Hope to see you again
guys.
soon. All right, oil prices edging higher as a bigger drawdown in inventories in the U.S. and Chinese import data help support crude in today's trade. Yahoo Finance's Ines Ferre has more on that story for us. Ines.
Yeah, Shana, those higher import data coming out of China signaling demand growth, and that's partly why you are seeing oil prices higher. We also have been seeing falling inventories here in the U.S., so that data yesterday sent oil higher. But taking a look at WTI, it's just below $80 a barrel, and Brent just above $84 a barrel. If I pull out a chart, a 2-month chart, you can see that since the peak in April, on April 5th, you saw oil oil coming down about 8%. That's a pretty big drop in a short amount of time, and oil tends to overshoot and overcorrect as well. So there are some analysts that said that we are in too much of a correction territory, so you can expect to see a little bit of a bounce when it comes to oil. But nonetheless, look, Goldman Sachs yesterday put out a note saying that they're expecting OPEC Plus in their June meeting to extend their production cuts now. And all eyes are really on that oil alliance to see where they go with their production cuts beyond June. The expectation is that they will extend them because Brent right now is trading at 84, but the range that a lot of analysts are seeing for the second half of the year is around 85, is between 75 and 90. 90 is really the ceiling, so basically saying that OPEC Plus doesn't want oil to go too much past 90 because then you cause a recession. So nonetheless, we are seeing Brent 84, and the expectation is that that ceiling for Brent is going to be 90, guys.
All right, Ines, thanks so much for breaking down that trade and some of the movement that we're seeing here in early action. All right, keep right here on Yahoo Finance. We got much more. Stay tuned. You're watching Catalysts.
Let's do a check of the market, sponsored by Tasty Trade. Seen a mixed bag here. You got the Dow up about 100 points. You've got the S&P 500 just barely above the flat line. The Nasdaq, though, down about 0.1% here. Taking a look at some of the individual movers, we're seeing a lot of those weighing on the overall trade. You've got Airbnb, the second to worst performing name in the S&P 500. You've also got Salesforce, Accenture, and SMCI weighing down the S&P. But on the flip side of things, when we take a look at treasuries, we are seeing some movement in yields to the upside this morning after some of that economic data, Shauna.
All right, let's turn to the streaming space because shares of Warner Brothers Discovery moving to the downside after the streamer reported weaker than expected results for the first quarter. That report coming on the heels of a big announcement. Consumers are getting a new bundle option, which includes the Warner Brothers Max service, Hulu, and Disney Plus. Here with more in the streaming space, we want to bring in Jessica Reif-Ehrlich, a senior U.S. media and entertainment analyst at Bank of America. Jessica, it's great to see you. So talk to us just about this quarter and this print that we're getting from Warner Brothers this morning, because yes, they did miss when it comes to some of those top and bottom line numbers, but subscribers did beat. The company is paying down its debt, yet it looks like investors are still disappointed. Why?
Well, I mean, actually, the numbers were pretty solid. The miss, in our view, was based on a write-down at the studio, which happens. But on the direct-to-consumer side, they beat the number. It was almost $90 million in EBITDA. Subs grew 2 million, better than expected. And in this case, for Max, we'd say the best is yet to come. They're just rolling out in Latin America. They're rolling out in the next few months in Western Europe, most of Western Europe, right before the Olympics. So they're really kind of rolling out globally, and that will be a big part of the growth. And then don't forget, there were the 2 strikes last year. So Max, along with all of the other streamers, did not have a lot of original content. Netflix, of course, buys a lot of content from third parties. But Disney, Max, and some of the others had a lack of originals, and that will change in the second half of this year. So we'll see The Penguin and a lot of other original shows.
We love to see the original content, Jessica. I know that you reiterated your buy rating on the name post those earnings, but I'm curious about this bundle announcement that we got. To what extent do you feel like they needed that announcement, or were you going to be having this positive sentiment about this name regardless of that bundle announcement this morning?
Well, we wrote in our year ahead that one of the biggest trends that we expect to see in this year will be bundles. So we've seen, maybe say the collapse, but the collapse would be too strong, but decline of pay TV, which is ongoing. And then you're seeing a rebundling in streaming. And so, we've seen Verizon offer Netflix and Max, and Disney put Hulu, and eventually we'll put ESPN. And that, I think, is a trend that will continue. So Warner Brothers Discovery putting Max with the Disney streaming platforms, I think is very positive. Who's stronger than Disney? Except for Netflix. So it should be a powerful bundle. We don't know the pricing, but what bundling does in general is it decreases churn. It generally keeps people on a platform because there's so much content, and it helps with marketing costs overall. But churn is the biggest issue in streaming. It's so easy to get on and off a platform as opposed to cable when you sit around and wait for the technician to take your box. It was just a pain.
Jessica, one of the questions that was asked this morning on the earnings call was surrounding NBA rights and what that looks like here for Warner Brothers Discovery. And David Zaslav answered that in part, saying that he remains hopeful that they will be able to reach an agreement and have it make sense here for both sides. How critical are NBA rights here for Warner Brothers Discovery?
They didn't really get into NBA at all because they're negotiating, but it's really important, and it almost feels like a no-win at this point, and maybe we'll just have to see. But when I say no-win, they either keep the rights and pay a lot more than they expected. So our expectation going into this was they would pay $1 billion or so more than the 1.3 billion they're paying now for rights on average, and get less content. NBCU reportedly, we don't know for sure, is coming in with a bid of 2.5 billion. So Warner has the right to match. Warner Brothers Discovery has the right to match. We'll see what that means ultimately, but it may be more expensive. If they don't keep the rights, that's a real problem because it really puts the future of TNT and TBS, the affiliate fees in question, the profitability. So I think either way, we really have to think about a step down in our 26 forecast. but we just don't know at this point.
Yeah, Jessica, I'm curious, how big of a step down do you think it could potentially be? And then also just the immediate impact then potentially on the stock if they were not to get those rights.
Well, in reality, it would be a one-time impact, but it's a little bit different if they pay up a couple of hundred more than we expect versus completely losing NBA, because so much of what's driving viewing today is live sports, whether it's the NFL or basketball. You can see, even with the decline in the pay TV universe, the ratings are up dramatically. So this is what's driving affiliate fees. It's what's driving advertising. So NBA is really important. It's a global product. Warner Brothers Discovery has international sports properties. We'll see if that helps. NBCU has a lot of very strong local, domestic properties. They have a broadcast network. They of course, they also have streaming and cable networks. But so the asset mix between the two companies is a bit different. But it's important. NBA is a much younger sport than NFL. So I'd say it's look, we all think it's really important. And if there's a step down, how much of a step down depends on the outcome. Do they lose it completely? How much more do they pay if they keep it? We just don't know right now.
Well, speaking of another broadcasting network, CBS, according to the New York Times, Sony and Apollo's plan for Paramount would involve a little bit of a breakup, selling off CBS. I'm curious, from your perspective, who would a potential buyer be for CBS?
Look, what's happened in the last few years, in traditional media, there's been a slow decline in the broadcast viewership, of course. I mean, eyeballs have moved from linear to streaming, unquestionably. Having said that, broadcasters are really powerful. There are 4 broadcast networks in the country, and they have tremendous reach. So I think it would be a very attractive property. The question is who can afford it and who can own it from a legal perspective. The reason why this is being discussed as something for sale is that Sony can't own it. We have foreign ownership rules. They can only own a small piece of it. So they would have to sell it. So we'll see. We'll see if Sony and Apollo are successful in the end, or if Skydance is, or if nothing happens.
Jessica, not to put you on the spot, but I'm curious, though, from your coverage, obviously, within the space and clearly your extensive knowledge, how do you think this is going to play out?
I mean, look, it's really hard to say. The private negotiations, this can go on for a long time. We've seen this playing out for months and months, and they're very different offers. The Skydance offer with Redbird and KKR, supposedly KKR, we don't even know for sure, but that would be more of, with all of these things, there's a step 1 and a step 2. So step 1 is they buy out NAI, but then they want to merge their studio, Skydance, into Paramount, and so Paramount would have to pay them. So there's that, but it would stay a public company, and you would have operators in a much bigger studio. And presumably they would do a lot of the heavy lifting that Paramount has not done, whether it's selling assets or cutting costs. We watched Warner Brothers Discovery go through 2 years of restructuring. That would have to be done. So there's really a lot that would have to go into a new Paramount, but it would stay a public company under the Skydance proposal. Under Sony and Apollo, it would not be a public company. Sony would run it, presumably would run the studio, and then sell off most of the other assets. So we're not sure, how do you do, what step 1 would be buying the company, and then would the government allow them to sell it later on? I mean, what is the process? Would they get through the government scrutiny of combining 2 major studios? Who would run this? Sony has amazing management. It's a really well-run studio for the first time almost ever. And so, how long will Tony Vinciquerra and Tom Rothman, who run the company, Tony's the chairman of Sony Pictures Entertainment, Tom Rothman is the head of the studio, how long would they stay? So, there are a lot of questions, and nobody's speaking to the public at this point.
All right, Jessica, thank you so much. We're going to have to leave it there. Really appreciate you joining us so much this morning. Jessica Reif Ehrlich joining us from Bank of America. Thank you. Now taking a look at some of the other trending tickers here. GoodRx shares down this morning after the drug pricing comparison software company posted its latest earnings report, coming in below analyst estimates. For more, we've got our very own Anjali Kamrani.
That's right, Maddie. We know that GoodRx has been under pressure for the last year or so. Really looking at the subscriptions has been a key part of that. While revenues are up year over year, they did miss on earnings per share. But meanwhile, looking at what the core business is, there have been some increases, such as the integrated savings program. The company has now linked up with major insurers like CVS and Cigna, but has not with United Health, notably, in order to allow those pharmacy benefits managers to automatically apply GoodRx savings to patients' prescriptions. That's been one area of growth for the company. Meanwhile, the general subscriptions that the company had, they have seen a 6% decrease year over year from 22.6 million to now to 24.1 million, and that is in large part due to Kroger. That has been one of the key areas that has pressured the company for the past couple of years. The decrease in that savings plan with those Kroger members, there's even a lawsuit that's been filed against them. So there's been a lot of problems with that area. But generally speaking, sort of flat. We know the market's responding poorly, down 7% already in the day. But the company has been up year over year right now in the past year, up more than 50%. And in the year to date, more than 20%, 25%. So, sort of mixed signals on the stock right now.
Some of it may be tied just to valuation questions then at this point. All right, Anj, thanks so much. Well, Alphabet, Google's parent company, is continuing to progress in talks to acquire the marketing software provider HubSpot. This is according to people familiar with the matter. According to recent reports, now the sources emphasizing that no agreement has been reached. HubSpot shares are up almost 40% over the last year. We're taking a look at shares not moving so much here today, given that massive run up that I just mentioned. You're looking at an uptick here of 0.3%. But again, what exactly does this mean here for Alphabet's business overall, where they're seeing the growth, where they're seeing the opportunity? You see, when they focus on a name like HubSpot, just exactly some of that strength that we're seeing play out here within the tech sector.
That's exactly right, Shauna. And this is HubSpot. As a reminder, this is a marketing software provider, so potentially a play from Alphabet to be working on that incredible advertising revenue that all the big tech firms have. Having said that, off of this potential deal, taking a look at the reporting when it comes to HubSpot, they did show some weaker customer demand conditions. For the fourth quarter's buyer urgency did dissipate. Barclays keeping to equal weight for this name. Evercore saying that it was in line, saying they delivered solid Q1 results, but the macro environment remaining choppy could be a headwind for the company to come. Cowen saying the same thing as well, flagging that tougher macro conditions are weighing on the stock, though it is up off of that Google news for them as well this morning. And Roblox shares are down this morning after the company lowered their annual booking forecast. That is a sign that consumers are pulling back on spending on the video game platform. Now, this comes after Electronic Arts also gave a weak revenue forecast as the gaming industry as a whole deals with a lower engagement. And guys, we got to just take a look at this stock. It is down over 20% here. I just want to pull up what the stock has been doing year to date so that we can get some of that context. It's down 30% year to date. Obviously, huge part of that is today, looking like the biggest drop year to date that this stock has had. So certainly a big market reaction here, Shauna, when you take a look at what's going on with Roblox stock today.
Yeah, it actually was off just over 30% ahead of the market open. It had been on track for the worst day that we had seen here, I believe, on record, but now it had paired some of those initial losses here, off just about 22%. But again, this is a read on the consumer. When you talk about falling engagement, when you talk about questions just how to further monetize the platform, the number of people who are paying and willing to pay and willing to play video games right now, when you see a bit of a pullback there in terms of bookings, obviously some questions about what ultimately this means for the current quarter, also for the second half of the year when we talk about that weakening consumer type of story. So Roblox obviously falling under a bit of pressure there today, and you're seeing a massive sell-off. And this is a stock that is actually in the red as well since the start of the year, given today's 22% drop, bringing that year-to-date loss to just around 33%.
Yeah, another consumer name really struggling here. All right, well, coming up, speaking of consumer names, we are going to speak to the Krispy Kreme CEO, Josh Charlesworth, on what's next for the franchise after its earnings report topping estimates. That's coming up after the break. Stick with us. We've seen fast food giants like McDonald's and Starbucks all report this season saying slowing consumer demand is a headwind for the companies. But Krispy Kreme actually seen some growth in that consumer demand that we saw in their Q1 earnings report out today. The donut giant seen net revenue grow 5.7% to over $442 million. So to break down what's next for the company, Josh Charlesworth, Krispy Kreme's CEO and president, and our very own Yahoo Finance's Brooke DePalma here for this discussion. Josh, thanks for being here. Let's jump right into that McDonald's partnership. You say that you expect over 80% incremental sales growth through that partnership. I'm curious how you anticipate getting to that number, particularly given what we heard from McDonald's in their earnings, that they are seeing consumer slowdown. How do you expect to see that amount of growth?
Good morning. Thanks for having me on. It was great results that we reported this morning, and they really reinforced that our strategy is working. Our strategy to get our donuts out to more people, and the McDonald's national rollout is all about that. Indeed, we can even, with a national rollout to McDonald's, access other major customers. And at the same time, the results this morning showed that Krispy Kreme consumer is excited about the brand. Lots of excitement around our special occasion varieties, and hence why the confidence in a national rollout in the consumer and in our expansion strategy.
Well, I'm curious then, because you talk about that expansion strategy, but you mentioned something that I want to follow up on, which is the frequency of the consumer. To what extent is that a potential headwind for you, that you are seeing consumers potentially coming in once, twice a year and not necessarily making Krispy Kreme a habitual part of their lifestyle?
Well, our brand and our business is pretty unique. People look to Krispy Kreme for a real special moment of joy, maybe to enjoy themselves, but actually usually to share and give to others. So we don't base our business off an habitual daily treat. Instead, we want to make it more convenient for people. We want to keep reminding them of the joy that's Krispy Kreme. Amazing new donuts. We got out minis for mum this week. We had a total solar eclipse donut just a few weeks ago. These all put it top of mind. And then, for example, on Valentine's Day in the first quarter, that was our biggest sales day in the history of the company, because we reminded people of these special occasions for them and their families.
Josh, I do quickly want to weigh back in on that McDonald's test. What exactly happened during that 160 store test that gave you the confidence that you could expand this nationally?
Well, the first thing is our Krispy Kremers did an awesome job in getting 3 of our people's favorite Krispy Kreme donuts out to more than 160 McDonald's across Kentucky, and they were great quality, fresh daily, and that was the most important thing for us. Then we saw the consumer reaction, and we also saw the partnership with the McDonald's team, and both worked really well. In fact, when we announced the national rollout, both McDonald's and us expressed that the consumer demand exceeded our expectations, which is great to see. So giving us a lot of confidence for a national rollout at McDonald's, but also the incrementality of that business for Krispy Kreme overall.
So I'm curious about these additional touch points here. You mentioned that you're going to have 12,000 of them. What is the single biggest thing that you're focused on in your leadership to increase capacity to be able to meet the demand that's going to come with that? That's a big shift.
Well, actually, we grew points of access nearly 20% just in the first quarter of this year. So for some time, we've been pursuing this expansion strategy by making our donuts more available. Number one reason why people say they may not purchase a Krispy Kreme still is it's just not convenient. So we're working to address that. So our team has been working on that. We're accelerating, indeed, with not just the national partnership with McDonald's, but other major players are looking to distribute our donuts. And so our focus is on getting those awesome donuts made, moved, and in the hands of our customers as fast as possible.
And talk to me about international expansion. I know you've expanded nationally, of course, through the McDonald's partnership. Why not go international?
Well, first of all, I mean, the brand is a global brand. People are always surprised when I talk to them about how we're in 39 countries already. Regarding McDonald's, yes, indeed, that's a US partnership, but we're growing all the time. We just announced we've added Germany and selling sales and Krispy Kreme in Germany next year. I was just recently at the Paris opening there, which the Parisians just loved our donuts. And we do think the quick service restaurant opportunity is relevant around the world. But right now with McDonald's, we're just focused on supporting the rollout there in the US.
With this rollout here in the U.S., what sort of opportunity does this give you to, say, go to those local Walmarts, those local Targets that are near these McDonald's?
No, I'm really glad you hit on that. It is a really big opportunity for us. In fact, when we've spoken to those partners, they've actually been excited to hear the news of how Krispy Kreme is growing profitably and scaling in a way that enables us to support more of their stores. We're in Walmart, they're a great customer, but we're only in about a quarter of the Walmarts today. Think of the opportunity we'll have by driving past every Walmart in the country on the way to McDonald's. And it's not just Walmart, other customers are excited to list a fresh, daily, awesome Krispy Kreme donut, especially given all the new donuts we bring out, all the innovation that the team is able to create.
When you think about what we're seeing here in the U.S., we have been seeing a consumer slowdown from so many other companies. It seems like Krispy Kreme is immune to that. Would you say that's the case?
I'd say we're always mindful of the consumer environment. It's important to be aware of it. But really, we're focused on making sure that the donuts are really top of mind and unique. For example, in the first quarter, we're able to generate over 17 billion media impressions by communicating our new donuts or reacting to situations like, I don't know if you recall the AT&T outage. We brought out a donut, especially that day, a free donut for those impacted. So we're always adapting to the environment and reminding people of the joy that's Krispy Kreme, and that's what makes us special, I think.
I know you announced a third-party delivery partnership in D.C. I'm curious about why not going with a bigger name for that partnership, like an Uber?
Well, we are exploring a few alternatives right now. DC, we're also doing something similar in LA right now. Our tests to understand how we can get our donuts to the delivered fresh daily doors, to these grocery doors, to McDonald's indeed, as we roll it out. And so the partner we've chosen right now is a test, and we'll be looking at different providers and seeing if we can maintain the quality and service whilst retaining the economics as well. So we'll see how that goes. All the while, our focus is on how do we modernize the making and moving of donuts so that we can make sure the company is supporting this expansion profitably at the highest quality.
Well, Josh, we really appreciate you joining us after this earnings print this morning. Thank you so much for making the time to chat with Yahoo Finance. That was Josh Charlesworth, the CEO of Krispy Kreme, and of course, our very own Brooke DePalma. Well, a rebound in advertising sales is giving companies a boost this quarter. Latest results from Instacart showing a 9% jump in ad revenue from a year ago, coming after Reddit, Meta, Amazon, and Alphabet all seeing double-digit growth. But companies still dealing with a cautious consumer. Recent data from McMack showing a pullback in purchase sizes from a year ago. Joining us now is Rachel Tipograph, McMack's CEO. Rachel, great to speak with you. Thank you for coming in studio with us. So McMack, as a reminder, a leading global platform for e-commerce, and you have a lot of analytics that help you understand and really get a picture of what's going on with the consumer. So what are you seeing?
Yeah, absolutely. Advertising is definitely back. The investments that the platforms have made in AI have lowered the barrier to entry for businesses of all sizes. And the reality is what every consumer company is focused right now on is profitable growth. And they're willing to invest in channels that will deliver a strong return on ad spend. And as platforms have become more sophisticated in advertising, brands are seeing greater results. I'm talking about platforms like Meta, like TikTok, like The Trade Desk. Even Reddit has seen a boom lately.
So Rachel, when you talk about the fact that you think ad revenue growth then is back, what then does that growth look like going forward?
Yeah, it's super competitive because there are more places to invest your dollars than ever before. It's no longer the digital and social platforms, it's the retailers too. Amazon, Target, Walmart, Instacart, they've all woken up and realized that they have an enormous amount of first-party data. Why? Because consumers every single day are shopping on those platforms. It's now actually given them a competitive advantage over the digital and social platforms because of changes in iOS 14 and cookieless internet. So while advertising spend is back, from a platform, they have more competition than ever before.
Can we talk a little bit about Instacart, because they have this new Uber partnership, which is a big deal for them, obviously. I wonder in your data what you're seeing that indicates to you that Instacart does have a stake in the game, like a real position when you have those competitors like Amazon, like Walmart.
Yeah. So at McMac, we work with over 1,200 brands. These are the biggest brands in the world. And on any given day, Instacart is our 4th most preferred retailer, meaning it goes Amazon, Target, Walmart, Instacart. Why? Consumers want convenience. So Instacart teaming up with Uber, I thought that was brilliant, because what's happening right now is because there's more fragmentation in the market and consumers want convenience, you're actually seeing channels converge. So for example, last year you saw Sephora and Kohl's come together. Instacart and Uber coming together is a great value proposition for the consumer, because what does the consumer want to do? They want to order Chinese food delivery and then add a pint of ice cream to it. Instacart and Uber can deliver on that, and DoorDash recognized that strategy a year ago. So this is going to be really interesting in terms of being a competitive threat to DoorDash.
Rachel, do you expect to see more of those types of partnerships, just given, if we zoom out a little bit, there's a lot to be optimistic about, like you're talking about, but then there are certainly macro concerns. We do see pressure on the consumer. We do see consumers beginning to pull back their spend. So are these top brands going to be more reliant then on those types of strategic partnerships?
Absolutely, but the reality is margins are now being compressed across the board. What happened during the pandemic is that big consumer brands realized that they could raise prices because the need was there. All of a sudden, consumers are like, wait a second, I'm not going to pay more for avocados. And now there's resilience towards the increase in price. What that does for a brand manufacturer is it makes them think twice about their margins. The same thing is happening for retailers. And so as there's more competition and there's more convergence, the reality is Instacart and Uber are now going to share revenue. So if I'm on Wall Street, I'm just wondering, where is the margin compression going to stop? And how are brands and retailers going to find growth in tomorrow's environment?
Well, as we start to get to the end of our conversation here, I do want to take a moment to talk about TikTok. Are you seeing any evidence of companies starting to prepare for a world where they may not have access to TikTok?
So on any given day at McMac, TikTok is typically now around our 2nd most trafficked social platform. It goes Meta, then TikTok, then an environment like YouTube, Pinterest, Snap, and then X is irrelevant. I share this because I'm not seeing brands pull back from TikTok. I think right now they're actually trying to put their pedal on the gas while TikTok's around. TikTok is an amazing channel to drive consumer growth. We're seeing it in beauty, we're starting to see it in grocery, and so if TikTok was to go away, which personally I don't think that's going to happen, I think there will be a divestiture, and my money's on Microsoft. But why is that? Because I think that the FTC is going to block everything, but with Microsoft, there's an opportunity for them to truly become one of the biggest players in advertising with their inroads in AI, and if they acquire TikTok, this is a home run.
Rich, so I know this isn't what you think is likely to happen, but let's just play devil's advocate. If we were to see a ban and they weren't to divest that part of the business here in the U.S., what then does that ultimately mean here for some of these other social media players, just in terms of gaining the edge? And I guess, where do you see those ad dollars going?
Yeah. If TikTok were to go away, Meta would win, YouTube would win, CTV would win. TikTok is really a play of brand awareness and video. And so those dollars would just get reallocated. I saw it happen when Elon Musk took ownership over X. Our Twitter traffic plummeted, and then overnight, just reallocation. And that's the thing. Consumer brands have a lot of choice of where to place their advertising dollars, but TikTok is so a part of culture. And so I do think it will have a big pullback from consumers, because where's Gen Z going to hang out? They don't want to hang out on Instagram. Maybe they'll go back to Snap. Maybe Reddit has an opportunity.
Well, Rachel, it's great to have you here in studio. Thanks so much for stopping by here with us.
Thanks for having me.
Keep right here on Yahoo Finance. We got much more of your market action ahead. Stay tuned. You're watching Catalyst.
a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
Elon Musk's startup Neuralink is facing some setbacks after announcing the brain implant it placed in its first human patient has malfunctioned. The company announcing in a blog post that it encountered a problem leading to a reduced amount of data that it could capture because of some of the threads coming out. Now, just to explain this, is sort of complicated. This is a brain-computer interface that was implanted into this patient here, Shauna, and the interface has over 1,000 electrodes across 64 threads. The implication here is that some of those threads are not functioning. We don't know how many, but that is a very important part of the process of having this brain-computer interface implanted into that patient's brain that allows this patient to do things like play chess without having to use his hands. If those threads are no longer functional, that's a huge issue.
Yeah, it is a huge issue. When you take a look at this blog post here, it wasn't immediately clear, or they did not disclose a reason for some of those threads, the fact that they did react or retract here unexpectedly. So when you talk about what exactly this means then for the patient who has a Neuralink implanted in his brain, there's many unknowns when it comes to this, obviously, since this is the first time that this has ever happened. But they are saying right now that the problem hasn't appeared to pose a risk right now to the safety of the patient, but there are talks, at least initially here, according to this journal piece, the possibility here of removing the implant, a so-called explantation here, was floated according to recent reports. So again, lots of questions just about what exactly this looks like here going forward, what exactly this means then for further adoption, obviously. And so I think there's a lot of unanswered questions at this point. But again, the focal point being the safety of the patient. It looks like at least now some discussions are taking place just in terms of what ultimately would need to happen, or about if there is this possibility of having to remove the implant.
That's exactly right, Shauna. Well, this is part of a broader push that we're seeing from big tech companies looking to invest specifically in what's called neurotechnology. And this is the focus of our upcoming episode of Next. Take a look.
I think we'll start getting some consumer neural interfaces soon.
It's kind of like a Fitbit in your skull with tiny wires.
CEOs from the world's biggest tech companies are touting a future that allows you to type and click using only your mind.
It won't necessarily be due to a chip that's implanted into your brain. Rather, experts say the next big thing in neurotechnology will be portable products that live completely outside of the body.
Like this. Since 2021, Meta CEO Mark Zuckerberg has touted an armband that can allow you to control devices using the subtlest of hand movements. Apple also filed a patent for AirPods that could include electrodes to measure brain activity.
As big tech firms circle around neurotechnologies, one estimate says
the industry could be worth $55 billion, but questions remain about privacy concerns associated with the technology.
This is our final fortress of privacy, and we've given up every other aspect of privacy that exists.
And you can catch that full episode of Next premiering here at 4:30 p.m. on Monday.
Looking forward to that, Maddie. All right, let's talk about one of our big takeaways here from the show and really what we have seen play out over the last 24 hours. And that is first quarter earnings season. We are in the final stretch. Some of the focus that we've been talking about, we talked about it with Scott Cronert over at Citi earlier here this morning, has been on buybacks and the uptick that we have seen in buybacks specifically this quarter. And just to put it even more plainly here, put it very, tell you exactly what this means here when you compare it on a year-over-year basis. We're actually looking at the fact that buybacks have ticked up, I believe, just around 16% compared to what we saw a year ago. $181.2 billion worth of buybacks have been disclosed here for the first quarter results. So what does this mean? Obviously, this signals that executives are confident within their company, and this comes at a critical time here when there is so much uncertainty when you talk about the economy and exactly what is going to happen with the Fed moving forward. But what we heard from Scott Cronert over at Citi was he was talking about the fact that they're actually looking for a free cash flow here to grow by about 10% this year, giving companies more choices. When they have more choices, a lot of them are putting that money to work through buybacks, and then ultimately what that means in terms of further supporting here the market from current levels.
I wrote that number down. I was thrown off by 10%. That just seemed like a lot, particularly given his thesis that this season is going to be a beat then hold, because we're seeing good results, but then we're not necessarily seeing stocks rallying off of those results. So I thought that was super interesting, a great point for you to bring up, Shauna. I also thought that what he said about how buybacks are another part of what's leading to the bifurcation in the consumer was interesting, that those consumers that have the ability to have holdings in Apple, for example, and they're getting the benefits of those buybacks, that's giving them some form of income. Whereas on the lower end of the spectrum, we're seeing that people who are impacted by higher for longer environments, that's making their credit a little bit more expensive. And that's part of the dynamic that's leading to this separation here.
Yeah, exactly. When you take into account why this is happening, clearly that bullish signal that it is sending to the markets. And as a result, we see many of these companies who have announced buybacks, we've seen a tick up in their stock here the following day, and then even over consecutive trading days here. Not necessarily a big surprise, but again, a trend that we have been noticing here at Yahoo Finance, and certainly something that you want to keep on your radar as we close out first quarter earnings season. Let's do a final check of the markets here 90 minutes into the trading day. Now you're looking at gains actually across the board. You've got the Dow up nearly 200, S&P up about 0.3%, the Nasdaq back in positive territory, now up about 0.2%.
And coming up, wealth dedicated to all of your personal finance needs. Brad Smith is going to have you for the next hour, so stay tuned.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and tricks that you need to grow your money. On today's show, travel trends. Oh yeah, pack up, everyone. We dig into consumers' plans for travel this summer and how they plan to pay for it. And come summer, consumers will have a new streaming bundle option. We'll tell you all about the big announcement that you need to know. Plus, whip out that wallet or pocketbook and show me the money, of course, that famous line from Jerry Maguire. We talk to an expert about how much cash you should always have on hand. All that and much more coming up during today's show. We're kicking off today's show with consumer spending, though. Inflation isn't slowing down Americans too much. More travel companies are seeing some healthy trends of consumer spending ahead of the key summer travel season. Here with that breakdown, we've got our very own Madison Mills. Hey, Maddie.
Hey, Brad, thanks so much. Well, listen, we've been talking about how maybe the weakness that we're seeing in the consumer when it comes to some of these consumer-facing brands, think your Starbucks, your McDonald's, we've been saying, hey, that's okay because they're still spending on travel and services. If you look at the data that we're seeing from today, that story not necessarily holding here. Let's take a look at Airbnb. Deceleration in North American nights booked in the first quarter. Now, the CEO is saying that they are working to differentiate, working to get more hosts on the platform, but that was not enough to help them this quarter. You can see there year over year, nights and experiences booked up 9.5%. The street was looking for a higher number than that. That's why even though that we're seeing that growth, it just was not enough, especially compared with previous growth cycles that we've seen from Airbnb. And then you have the stock here moving to the downside, down a little over 6.5% here. Interesting to note when it comes to the stock performance that Airbnb is having their worst day since May 10th of 2023. I also want to take a look at what we're seeing from Hyatt. Their earnings dropping a little over 5%. That is the most intraday since February 13th. They cut their adjusted EBITDA guidance for the full year, and their guidance missed the average analyst estimate. So that full year guidance indicating that they are not seeing the demand that they had previously. That's also interesting, Brad, you told me this, that Airbnb was looking to some of the cities that don't have hotels as a potential growth area, but even the hotels starting to struggle. So I don't know how successful that effort is going to be, Brad.
Well, it's also the marketing efforts that all of these companies have to put forward right now, too, in order to really give the value proposition, put it front and center in front of consumers right now who are being more decisive about where they're spending their dollars, even in this experience economy. And that's actually something that we heard from Airbnb about on the earnings call. The executives talking about marketing being one of the line items that you could potentially see some margin compression in order to drive growth. And then additionally, they're talking about some of the other areas that are trying to accelerate the product roadmap. They could be bringing on more headcount as well. That's some of the margin compression. Share prices reacting accordingly here. But then, as you mentioned, on the Hyatt side, I mean, that's remarkable for the sheer amount of consolidation that we've been kicking around here and seeing discussed within this industry to really reshape the accommodation space right now.
And the inflation narrative continuing to be an issue. I mean, for Airbnb, I know this is just according to social media, but people messaging the hosts separately and trying to get their rental without having to pay the Airbnb fees. So they're cutting out the middleman there. That is not going to be good for Airbnb, but it indicates that the consumer is at a point where they don't want to pay a service fee anymore. Like, what is that?
Yeah, user-generated anecdotal data. We'll classify
exactly. That is what that is. Yes.
Thanks so much, Maddie. Appreciate it.
Thank you.
Well, sticking with the travel industry, inflation and tight budgets don't seem to be too much of a concern for Americans this summer. In fact, travelers seem to be fighting off stubborn inflation by paying for their summer vacations with alternative payment methods in some instances, like BNPL, known in your hood as Buy Now, Pay Later. For more on this, I'm joined by Haley Berg, who's the Hopper lead economist. Haley, always a pleasure to grab some of your time, and thanks so much for joining us here on Yahoo Finance. As we think about how people are paying for travel, how is that different, even year over year, from what we saw last year?
We're really seeing generational shifts in how people are thinking about paying for these bigger ticket items. Traditionally, the path has been you start with a debit card, you build a little wealth, you open a credit card. But for Gen Z and millennials, more than 30% of travel purchases are actually coming from alternate payment methods like Buy Now, Pay Later. So they're expanding their travel wallets with these different methods at a rate more than double what we see from boomers and even Gen X.
And so with that in mind, how are they tapping into perhaps even the ability to pay in increments over time as well on travel?
Buy now, pay later is great for travelers who are making a bigger travel purchase. And what's interesting is it's actually one of the number one ways that travelers in Latin America pay for travel and big ticket items. So it might be newer to North America, but this is the norm in other parts of the world. But it's a great way to take a big ticket item like a 5 to 7 night stay at a hotel, which could be over $1,000, and spread the payments for that travel over time so you don't have to go so far out of pocket. That in turn makes many destinations and experiences more accessible for travelers who have a smaller budget.
Is there a good rule of thumb, though, that people should still be keeping in mind when it comes to how much they're kind of breaking up or how much they're paying up front? And I ask that because at a certain point, the trip just doesn't become feasible or it just doesn't seem like it's good money that's being spent if you're breaking it up to the same extent that you might be a mortgage for a trip.
Absolutely. The good news is that though we're seeing the adoption of these payment methods that do help travelers spread payments, we're still seeing deal-seeking behavior and price sensitivity. So travelers aren't just blowing their budget on something that they can't quite afford out of pocket. Mm-hmm. In fact, we're seeing that even though most travelers are expanding their travel budget this year, about 75% of our users at Hopper are planning to spend the same or more. Almost half of them are going to take more trips. So they're expanding that travel budget a little bit, but packing more into it, which means that they have to be looking for sales and promotions, booking at the right time, doing those deal-seeking behaviors that make the price more affordable.
Certainly. Where are some of the top locations that you've seen travelers still really be willing, gung-ho to spend on this year?
You know, Paris, London, and Rome are always the top 3 destinations at this time of year. They are destinations people dream of, their lifetime or bucket list trips. So we're seeing a tremendous amount of demand to those destinations. But more often than not, some of the more interesting trending destinations that we're seeing are being driven by these younger generations of travelers. And those are destinations in Portugal, the south of Spain, Alaska, destinations much more off the beaten track than what we typically see from the traditional American family going on a bucket list vacation.
Haley Berg, Hopper lead economist. Haley, thanks so much for taking the time here today. Really appreciate it.
Great being with you as always.
Absolutely. All right, everyone, we've got much more wealth coming your way after this short break. You're watching Yahoo Finance. Let's do a quick check of the markets, sponsored by Tasty Trade. Taking a look at the major averages right now, the Dow, the S&P 500, and the Nasdaq all higher across the board. The Dow right now up by about 0.5%, leading the pack on a percentage basis. The S&P 500 higher by about 0.4%, and the Nasdaq Composite up by about 0.25% right now. Let's stay on consumer spending. A Bankrate survey finds 50% of loan applications are denied. But maybe tech can help. AI might be able to help applicants gain access to credit that would otherwise be rejected. And that's what our next guest's company is doing. Joining me now, we've got Gal Krabiner, who is the Pagaya co-founder and CEO. Gal, great to have you here with us this morning. First, walk us through how AI can really kind of stand in the gap for improving someone's credit score in order to make them more credit worthy in order to get a loan.
So, Brad, first of all, thank you so much for your time and pleasure to be here. The statistics you started with are exactly the problem we're trying to solve in the US. 42 to 50% of people are actually getting denied to credit, although they should get. And what we do here in Pagaya, which is our mission, is we're trying to enable these borrowers to get more loans more often for their financial needs. Now, the way we do it is rather different. We are connecting to the banks that otherwise would have denied these borrowers, and we're helping them use AI to identify the borrowers that should actually get a credit, and by that, reducing the 42 or the 50% lower to be able to help them help their customers. Now, the interesting side is that the money we're using is not the bank's balance sheet. We're actually created on the other side of our network a very strong, stable funding capabilities that is based on the biggest asset managers and pension funds and insurance companies in the world to be able to fund all these additional loans that are actually a very good performing loans of the people that otherwise the regulatory environment in the bank system will actually deny them.
So these are not kind of an additive like peer-to-peer loan. How would you define what this actually is?
So I would define it as an enabling finance AI solution that is really targeting only the big financial banks in the US. And quite frankly, today, we announced the addition of Elavon, which is a top 5 payment global system, as part of our partners. And next to them, we are working with US Bank on the personal loan. So we are helping them approve more personal loan. We are working with Ally to approve more auto loans. And we have working with SoFi, for example, to approve more personal loan, and even Klarna on the point of sale.
How does AI remove bias from loan servicing?
So I think the real interesting part about the AI piece is that it allows to go above and beyond the traditional way that people think about credit scoring or credit risk. So for a US system or for FICO score, 700 FICO is very different than 699. For AI, it's not. So AI has the ability to go deeper into the data and use the vast majority of data that is behind the credit score and actually come to a conclusion that the difference between 699 and 700 is not that big. And therefore, to allow for that person to get a loan as he was or she a 700 FICO.
And take us into Pagaya as the business. I mean, what is your profit model? How do you make money on this?
So the way we make money is really by connecting the institutional lenders on the one hand side of our network with what we call the lending partners, which are the banks that I just shared. And we are taking 3 to 4% of the loans that are being originated for doing all of that, for pricing the loan, for connecting things, for being able to fund it. So we are the connectivity tissue of, if you want to think about it, the private credit and the public credit of the world that, as we know, is getting bigger and bigger, and you see the names of part of them on the screen, together with the loan origination systems of the big banks to allow for that streaming and the future of finance through the power of AI and connectivity to take to a completely new route.
All right. I'm seeing your most recent earnings, record network volume of $2.42 billion, 31% growth year over year. Good stuff there, Gal. We got to catch up in the future as well to see how the business is scaling. Gal Rubino, who is the Pagaya CEO and co-founder. Thanks so much.
Thank you so much, Brett.
Certainly. Let's turn now to the economy and how Americans are spending money. High inflation has had a big impact and effect on consumers over the last year or two. A recent Wells Fargo survey found 2/3 of Americans say they've cut back on spending, with a third saying that they've dipped into savings or investments. But our next guest, who comes from the fitness world and part of our Health is Wealth Week here, says although their clientele may have had to cut back in some areas of spending, health and wellness has remained a priority. Here with more, we've got the CEO of Barry's Global, Joey Gonzalez. Joey, always a pleasure to grab some time. Thanks for hopping on with us.
You too. Good to see you. Thanks for having me.
Absolutely. Let's dive into this. I mean, what are you seeing in the consumer landscape and all of those that are coming into the Red Room right now in the fitness experiences, where they're spending further or where they're making tough decisions to pull back?
Well, all we know is what's happening in the Red Room, right? And so all I can say is that if inflation is impacting our clients, they're definitely choosing to prioritize fitness and wellness, as we've just continued to see record results across the globe. This past April was actually the highest attended month in Barry's history.
Wow. Okay. All right. I know you've got a few members from our control room as well that have made their voyages into the Red Room. As we think about the pricing mechanism too, I mean, this is a business that involves coaches who have to offset the impacts of inflation with the ability to make sure that they're making more. You've got a business that you're running on, a different location basis in different geographies and regions around the world. What type of input costs have you seen kind of moderate, and how is the business going about really making sure that you're giving the same experience and not sacrificing on service, while at the same time knowing that there are some fluctuations in the prices that really need to be considered here?
Yeah, I'd say from just a general overall company standpoint, as costs have increased, we've just had to find ways to operate more efficiently, both through value engineering in our actual build outs, because we've been opening a lot of studios, and creating more operational efficiencies within our actual studio expense model.
Certainly. Is there a smart spending way that people who are booking any of their boutique fitness classes or instructed fitness classes can make sure that they're kind of staying within their budget, but at the same time getting the health, the wellness that gives us that work-life balance?
Yeah, I think we reward frequency in our pricing model, obviously. So we've been seeing some uptick in memberships for the more value-driven consumers who really want to get the most bang for their buck. So I think making a commitment to fewer brands or choosing a brand where you feel like you could get the best workout is going to end up paying off.
What's the next big investment that you foresee Barry's making into its fitness experience?
We have a combination. We're continuing to expand into new markets and new market types, as well as infilling our current markets. We opened Santa Monica and Studio City in the upcoming 30 days. But we're also really exciting about scaling our new product called Ride Lift, which is a low impact alternative to what we do with the treadmills. We've replaced the treadmill with cycling. So you're weightlifting and you're cycling and you're getting an amazing HIIT workout. We're in LA, we're in Chelsea, New York City, and planning to scale that, as well as another concept we have called Lift, which is just 50 minutes of pure strength training. And we have 15 of those studios globally.
I'm wondering, even as we were talking about where people are prioritizing their spend for fitness, how you're kind of tracking across different income levels. I mean, we talk about Chipotle so much, for instance, and that if there is a trade down even among the kind of high-end consumer, that Chipotle will still capture that. And even when there's a trade up from the low-income consumer, Chipotle will still capture that. What does that look like for Barry's on the fitness side, if you will?
Yeah, I think that's interesting. I think the one example that comes to mind, Barry's been around 26 years, so we've been through a recession. And I do remember just anecdotally in 2008 and 2009, we had some people trading down from personal training, right? Because to use a personal trainer at a gym costs at least 4 times what a Barry's class is. So that's one example, I think, of movement we see during those times.
Certainly. Barry's global CEO, Joey Gonzalez. Joey, great to see you as always. We got to catch back up in person. I got to make it down to Florida. I mean, I'm just ready for some consistent 80 weather days here. I know it's probably a little.
We'd love to have you.
All right, good to see you, Joey. Thanks so much.
Take care. Thank you.
Just months after United Healthcare was hit by a cyber attack, another healthcare provider is facing a breach, and patient care was affected. Here with more, we've got Yahoo Finance's Anjali Khemlani. Anjali, what do we know about this most recent one here?
Yeah, Brad. So this one is a little bit different because it is an actual hospital network rather than the insurer and the underlying payment pipeline. So by scale, the attack on Ascension that happened yesterday was a little bit smaller, but still important to note that this is part of the broader problem. The healthcare industry has been racking up these cyber attacks. They've been noting them for quite some time. Ascension is one of those larger hospital systems in the U.S. It exists and it has facilities in more than a dozen states, and it has 140 hospitals in these, as you can see on your map, these states. It also includes 40 senior living facilities, and by size is a $28 billion revenue system. So quite large on the scale of the country. The company did say in a statement that there has been a disruption to clinical operations as they continue to assess the impact. They noted it happened yesterday, and they are still in the throes of trying to figure it out. Looking, by comparison, we know that the United Healthcare attack was much larger, right? The company is looking at already 1.6 billion impact for the year, and it really stopped the flow of payments as well as some appointments as well as some pharmacies for several weeks. Meanwhile, we do see this clinical interruption for care for Ascension, and it's unclear how long that will last and any other details right now. Those are still being assessed. But back to the point about this is part of the larger picture. The Health and Human Services Department has noted that between 2018 and 2022, there was a rise by 93% in cyber attacks. And of those, a 200, and I believe it was 78% increase of those breaches that included ransomware. So we're talking about a really big problem in the country that has been highlighted by the United Healthcare change, healthcare impact. And then now we're starting to see just how prevalent it is just by this a few months later, this same attack right now.
All right, huge investigation that's going to be ongoing. Anjali, we appreciate you setting the scene and breaking it down for us here. Appreciate it. Yahoo Finance's own Anjali Khemlani. We've got much more on wealth after the break, everyone. You're watching Yahoo Finance. While Disney and Warner Brother may normally be duking it out in the battle for viewers, the two rival companies are actually teaming up for a brand new bundle package for their streaming services. For more on the deal and what's inside is our very own Alexandra Canal. Hey, Ali.
Hey, Brad. Yes, more bundles coming for the consumer. Warner Brothers Discovery and Disney announcing this new joint venture. Now, customers will be able to choose whether they want the ad-supported tier or the ad-free option, but it brings all of those three streaming services into one platform. That's Disney Plus, Hulu, and Max. Now, we don't know exact pricing at this point, although management said that it'll be priced very attractively for the consumer and pointed to what the current bundle is with Hulu and Disney Plus. You can get that for $9.99 a month for the ad-supported tier or $19.99 for the premium ad-free version. So that is potentially where the pricing could land there. But on the earnings call, Warner Brothers Discovery was very adamant that this is going to drive business efficiencies moving forward. And ultimately, this is a play to reduce churn or customers leaving the platform continuously. They really want to retain that customer so that their loyal subscriber base and that they can continue that even as shows end and they see the changing, shifting of the audiences there. So, you know, we've seen bundling before. I think it's interesting now that we're seeing competitors come together. Before it was really more internal bundles,
right.
but now we're seeing that as customers are becoming a little bit more choosy with their plans, we need to have more of a synergy there amongst all of these streaming competitors.
Is it clear how many people would need to sign up for this bundle for these companies to determine it a success at the end of the day?
I think that's something that investors are closely going to be watching. It's also going to be interesting when you think about exclusive content. Most of the time, if you say something's exclusive to Hulu, Disney Plus, or Max, that'll drive subscriptions to that specific service. But if you're giving up all the goods there and bundling it together, what does that mean for your core service? So I'm curious to see if there's going to be any cannibalization when you think about customers signing up for this bundle as opposed to just being a Max subscriber or Disney Plus subscriber. But clearly the businesses think that there are real benefits here, especially when you think about a marketing perspective, all those costs, you're sort of sharing that across the board. So something that I think we're going to continue to see more and more of.
The old cost synergies.
Exactly.
Yes. All right, Ali, thanks so much. Appreciate it.
Thanks.
Well, we are living more and more in a paperless world. Apps now provide digital tipping options. You can send your friends and family money with the click of a button through Venmo and Cash App and others. But if the saying cash is king is still true, how much should you be carrying on you at all times? To help us with some of the tips here, we bring in Chelsea Ransom Cooper, Zenith Wealth. Great to have you here with us. First and foremost, you are Zenith Wealth Partners Chief Financial Planning Officer. I would like to get your full title in there first and foremost. Chelsea, how much should people be keeping on them?
This is a fantastic question, and it's evolved over time. Typically, when I have this conversation with clients, I notice that they only hold about $20 to $30 in cash. But over time, it's also come down quite a bit as well because cash is becoming the anomaly when it comes to how we're buying things. If you notice, a lot of people or retailers offer those little square cards where you can scan your card or your Apple Pay. It's a lot simpler to make purchases, and you don't necessarily need cash as much as in the past outside of just simple tipping.
And so with that in mind, I mean, there's how much you're carrying around in cash, and then there's also how much you are actually keeping in cash in the bank versus keeping in perhaps a high yield savings account or keeping in even, I don't know, a trading account. How should people be divvying that up?
That's really important to consider as well because we want to make sure cash is king, right? So we want to think about how much we have in our checking account. So the cash in our checking account is really a vehicle where we only want to have, 1 to 2 months of expenses there so we can cover our bills, any of our necessities, but it's just a transition place. When we think about that high yield savings account, that's where we want to have our emergency savings. And we love a high yield savings account because of the interest that's able to accrue by leaving our money in a safe, secure place. It's also important that that money is at least keeping up with inflation because inflation can really erode and eat into the value of our money if we're not necessarily being strategic about it. When we're talking about investing or how much cash that we want to put towards that, that's where we want to consider what are some of our long-term goals. Understanding that the stock market is pretty volatile, but that we still need some long-term growth to be able to achieve our financial goals.
What we're talking about at the end of the day here is boiled down to one thing, and that is also liquidity. How much of people's wealth, is there a good rule of thumb, how much of people's wealth should be liquid?
Typically, when we're thinking about how much is liquid, I would say anywhere from 2 to 10% of somebody's overall wealth is how much should stay liquid. You know, there's always a saying, stay ready so you don't have to get ready. And that's really important when you're thinking about how you're utilizing cash in your overall investment strategy or your overall portfolio.
Certainly here. And then when you're talking to clients right now, how are they monitoring, their own spending habits with also combating on a personal and household economics front, inflation as well, with regard to their own cash on hand that they're keeping in and kind of moving the dial on how much of that seems right for them?
So when it comes to how much cash that really makes sense on what they should hold on to, a lot of individuals are really thinking about how they can organize their accounts in a strategic fashion. So that's why we're talking about, how much is in that household checking account for any bills, but that first checking account really needs to be for any needs that you have. So I encourage clients to really focus on that 50-30-20 rule when it comes to their overall budget and spending, and try to focus on having 50% for any of those needs in a checking account, 30% for any of those wants in a second checking account. So you have a bit more control of where your money is going and making sure you're not overspending.
Yeah, no, that's a good piece of advice here. And then additionally, just lastly, while we have you here, Chelsea, I mean, the thing that's never fun to talk about, but it's less fun to be unprepared for an emergency fund here. I mean, how are you advising clients to set up their emergency funds?
One thing for an emergency fund is you want to make sure that it's inconvenient. A lot of the time when we open an emergency fund, we tend to open it in the same place that our checking account is. And sometimes we'll linger and dip into that on things that may not be emergencies. So if you make sure that your emergency savings or that emergency fund is in a separate bank than your checking, it's a little bit inconvenient, right? Now it may take 2 to 3 days to get that transfer. And then you really reconsider, hey, is this money that I really do need right now? Or can I let it sit in that high yield savings account where it's getting 4 or maybe even closer to 5% on annual interest through that vehicle?
I mean, look, the sneakers are going to sell out on the sneakers app. I mean, of course it's an emergency here, Chelsea. All things, I'm just kidding there. Of course, everyone, don't put that.
I don't know if that's an emergency.
Precisely. Chelsea Ransom Cooper, who's the Zenith Wealth Chief Financial Planning Officer. Thanks so much for taking the time, Chelsea.
Thank you for having me.
Absolutely. Everyone, we've got much more wealth after the break. You're watching Yahoo Finance.
Reddit's first results as a public company surprised a lot of people. The company hit profitability for the first time. Execs teased new products on the way, and you got the sense that Reddit, the platform, is growing up very, very fast. Steve Huffman, Reddit co-founder and CEO, joins me now. Steve, good to see you again. It feels like it was just yesterday with your IPO. Let's start on growing up fast. You know, I read the earnings release several times, the earnings call, and I really came away. This is a lot different platform than I think investors have come to think about it as.
Hey, Brian, good morning. Look, I think a lot of things are starting to click right now. So, like in the first quarter, we grew revenue 48%, users 37%, all-time highs, and as you mentioned, profitable. And because Reddit is such a simple business, high margin, if you combine that with discipline on costs, you can see how quickly we can get to profitability. And so it's I think not just a fun platform, but it's a simple and scalable business as well.
Yeah, we have a lot to get to in here, Steve. But real quick, are you spending enough? Your CapEx was so low, and we hear about Meta out there spending billions of dollars. Are you investing enough in the platform to support some of the growth we saw in that quarter?
The
number was so small, Steve.
I told my team, I was like, the economy is getting better when people start asking us to spend more again. Like at the moment, we're trying to do a couple of things. There's a lot of stuff that I'm very excited about building. So beyond the core product, we've got our user economy, we've got developer platform, we've got search, a lot of, I think, interesting and fun stuff coming. But we're also working towards profitability. So right now we're there on an adjusted EBITDA basis. The next milestone for us is GAAP profitability. And so I think we're in a good spot. We're basically building everything that I'm very excited about building, but also getting closer and closer to those business milestones.
Is just given the strength of the first quarter, Steve, is GAAP profitability this year?
Look, hard to say. We grew revenue 5 times faster than costs in this past quarter. The commitment we've made as a management team is about revenue twice as fast as costs. So it's just a matter of time, right? A high margin, so 88% in Q1, and cost discipline, that's the path to profitability. The exact timing we'll see, but I think we're on the right track.
And then the advertising business was strong. How sustainable is that, and how, why is that growth happening?
Look, I think the thing about Reddit is it's communities. And those communities represent every interest and hobby and passion imaginable, which means in addition to being fun for users, basically every company's customers are on Reddit somewhere. And our ads technology is getting better and better. And so if you're a company trying to reach your customers, and know that 30% of our users are not on Instagram or Facebook or TikTok, other big advertising platforms. You can find, as a company, you can find your customers uniquely on Reddit, often in a moment where they're talking about your product or brand or vertical. And so I think that creates pretty incredible opportunities.
Earlier this week, Steve, I caught up with Pinterest CEO Bill Ready, and a lot of conversation about making that platform shoppable. Now that's a word you mentioned on your call. Do you want to make it where I'm directly buying things from Reddit?
Well, I think in many cases, one of the things I joke about, but it's not really a joke, the most fun part about picking up a new hobby is buying all the new gear. And so every hobby, every purchasing decision, whatever you're into or going through is on Reddit. And so I think it's only natural to be able to connect the dots like that. So, first step is get the right customers on Reddit, our advertising customers, and then we just continue to chip away at our roadmap of making it easier and easier to find what you're looking for or even transact, like you suggest.
What could you tell us about the new user interface coming this year?
So, one of the most important things we've been doing, and I think what's really driving the user growth that we've been seeing, is we've just been focused on making Reddit easier to use. I've long said everybody has a home on Reddit. That is, your home, what you're interested in, is on Reddit. The challenge to us from a product point of view is, are we helping users be successful in finding that home? And over the last year, we've gotten much better at that. And as we look forward, our day-to-day work is really making Reddit easier to use, easier on the eyes, more effective at at finding your home on Reddit. So if you've been using Reddit a long time, I think you should be excited at all of the quality of life improvements that are coming.
Is there another Google-like deal for AI for Reddit to be had? And just in terms of, I guess, notoriety and dollar amount?
I think the potential is there. So Reddit's public content is really valuable. And we are in a situation right now where we're basically the only platform that is still open. Everybody else has closed off. And we believe in an open and interconnected internet, but we also need to be considerate about where our content goes and what it's used for. But Reddit has 2 decades of human conversation about pretty much any interest and topic imaginable, and it's up to date and it's relevant. And so I think if you are in the search business or you are in the AI business, which I think of as like search 2.0, then you, I think, basically can't be competitive without access to Reddit content.
Lastly, Steve, I like how you ran the earnings call. You took some, look like user questions, but tell me if I have this right. You did 8 practice earnings calls before you went public. I mean, it seems like you're just a really well-prepared management team, even though this was your first quarter as a public company.
You know, that was one of those things that worked out. So we thought we were going to go public way back in 22, almost 2 years to the day from when we actually went out. And so we did 1 practice earnings call with the analysts from our like syndicate banks. And then we just delayed our IPO for 2 years. And so we ended up doing 8 calls and did the whole kind of public company cycle, right? Board meeting, close the books, board meeting, earnings, follow-ups, all of that. And that was really great practice. And so I'm actually really thankful for how that worked out. And my suggestion would be for any company that's thinking about going out, try to get ahead of these processes or get a few reps under your belt sooner rather than later, because I think it really helped us.
You know, you and I, Steve, we both look, I don't know, let's say early 30s, but the bottom line is this, we're veterans of the battles, despite what we look like on cameras. Steve Huffman, Reddit co-founder and CEO, always good to see you. We'll talk to you soon.
Brian, thank you. Be well, everybody.
You betcha. All right, much more on wealth after the break. You're watching Yahoo Finance.
a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
Warner Brothers Discovery, a company with deep roots in the entertainment industry for over a century, but it was only formed a short 2 years ago. Beyond the Ticker takes a deep dive into the media giant's history as it grapples with legacy media challenges and looks to build its streaming business into a serious industry player. Warner Brothers was founded on April 4th, 1923, and quickly built itself into one of the big 5 American studios alongside Universal Pictures, Paramount Pictures, Walt Disney Studios, and Sony. In 1966, the Kinney National Company was formed. Its media division became Warner Communications. Meanwhile, Discovery was founded in 1982 as the Cable Education Network. The Discovery Channel launched soon after that in 1985. 5 years later, Warner Communications was established as Time Warner. That followed a high-profile merger with Time Inc. that created the largest media company at the time. Time Warner then went on to purchase the Turner Broadcasting System in a $7.5 billion deal in 1996. That led to the acquisition of assets like HBO, CNN, and Turner Sports. Flash forward to 2018, and Time Warner was acquired by AT&T for $85.4 billion. It was renamed Warner Media. The two companies officially merged in 2022 after Warner Media was spun off by AT&T, joining forces with Discovery in a deal valued at $43 billion. Trading began on the Nasdaq on April 11, 2022, under the new ticker symbol WBD. The stock opened at $24.08 a share. The joint company's first major project, the 2023 streaming launch of Max, which offered content from Warner Brothers, Discovery Channel, HBO, CNN, Cartoon Network, Animal Planet, and more. WBD is still aiming for a top spot in the ever-evolving entertainment industry, with investors closely waiting for its next wave of innovation.
Several real estate brokerage firms head to court today seeking final approval over a sweeping settlement concerning realtor commissions. And not everyone is happy about the proposals here. Here with more, we've got our own Alexis Keenan, who's been all across this. I mean, I'm just losing my words at this juncture because, I mean, there's so much that's on the table with this proceeding that's taking place.
There is a whole lot of dollars and cents here. So what's happening today, it's a fairness hearing in a federal court in Missouri, and it is to justify part of a whopping $900 million settlement. But that's really an alternative to a $1.8 billion verdict that a jury handed down in October to 500,000 approximately home sellers in Missouri. Now, if you remember back then, the jury said that the National Association of Realtors, along with its affiliated brokers, that they violated antitrust law by entering into these agreements with sellers, mostly, there are cases involving buyers too, that forced the sellers to fork over commissions to buyers' agents. Now, both before and after the trial, these defendants have been negotiating settlements. You have the National Association of Realtors, Berkshire's Home Services of America, and Keller Williams. They all went to trial. RE/MAX and Anywhere Real Estate, they did not go to trial, but they, along with Keller Williams, are in court today. And millions of people, millions of would-be potential plaintiffs, aren't happy with this $900 million. They don't want it. And they say that it increases the settlement class. That's one reason they really don't like this deal, because the original group of plaintiffs, those 500,000 or so home sellers in Missouri, well, now these agreements, these settlement agreements, they extend nationwide. Those are sellers dealing with these real estate brokerages and the NAR across the nation. That's approximately 30 million people as opposed to 500,000. So there are these copycat cases that had evolved after this, during and after this big verdict in Missouri, and those plaintiffs want their day in court. So their lawyers are in court today saying this settlement agreement, it's just unfair.
Okay, and so we've got an example, you do, of how these settlement dollars might work out for sellers. Tell us more about that.
Yeah, so basically in the first quarter of this year, the average home sale price in the United States, that was $420,000 approximately, okay? So this is just some sketchy math to give home sellers an idea of what they would be giving up here. Now, if you assume a 6% commission that would be split, that's the typical commission if you have representation on both sides of a residential real estate deal, giving approximately 3% to each side, split between buyers and sellers, that would be about $25,000 in that particular transaction that the seller would be forking over and having to pay a part to the buyer's agent. Now, if you take that bucket of $900 million that these defendants have on the table right now, you then slice out about a third for attorney's fees. If all of the 30 million eligible claimants here were to file a claim and ask for their money, they get about $20. So $25,000 versus $20, that's why these plaintiffs are upset.
Yeah, we all would be upset about that too. Alexis, thanks so much for continuing to track this proceeding. I appreciate it. Everyone, let's do a quick final check of the markets here as we're taking a look across the major averages here in the U.S. The Dow and the S&P 500 and the Nasdaq are all in positive territory. The Dow is up right now by about 0.4%. You've also got the S&P 500 up by about 0.25%, and the Nasdaq Composite, you're seeing that higher by about 0.1%. Taking a quick look at some of the sector activity as well here, it looks like almost all sectors in the 11 sectors of the S&P 500 are in positive territory, except, get this, technology. Technology is lagging right now. It's down by about 0.4%. However, 10 of 11 sectors in positive territory, led by real estate and energy. Well, that's it for Wealth, everyone. I'm Brad Smith. Thanks so much for watching. Stay tuned for Market Domination with Julie Hyman and Josh Lipton. That's coming up at 3 p.m. Eastern Time. You do not want to miss it. We'll see you back here tomorrow.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is Market Domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
Welcome to Stocks in Translation, our essential conversation cutting through the market mayhem, the noisy numbers, and hyperbole to give you the information you need for your portfolio. Now, I'm Jared Blickreed.